we have a gap down. I'm going to talk about the daily chart a little bit because I think it's important. When we were down here, I said we were going to bounce above the August 18th low because we've been in a trading range for over a year, and when the market's in a trading range and then you get a breakout, it normally pulls back beyond the breakout. So we broke above this high, we pulled back below it. We broke below this low, we should pull back above it. And that's what we've done. I said we'd probably ride for at least a couple of weeks. It's possible that we put in the low for the rest of the year. I guess I'm not convinced that we've put in the low for the rest of the year. However, I think we may get a third leg up here. So we got 1 pullback, 2 pullback, and we're still pulling back from this leg up. And I think we'll probably go higher. The bulls are trying to close this gap, which is about a 50% retracement of this September sell-off. And the bears are hoping that we're in a bear channel, that we're getting a series of lower highs and lower lows. So I think we'll probably go a little bit higher. Maybe we'll close this gap before we go below here. But I think we're going below here. And I don't know if we'll do it this year or if we'll wait until next year. Trading range. So traders are betting on reversals. When it goes up, they bet it's going to go down. Even if it goes up sharply, they'll bet it will go down. When it goes down sharply, they'll bet it will go up. We had a parabolic wedge on the open yesterday. 1, 2, 3. So 3 highs in a tight channel. So you'd expect a couple legs sideways to down. It's possible that all we were going to get was 1 pullback, 2. But this itself is a tight channel. So it was more likely the first complex leg and a bigger 2-legged pullback. So parabolic wedge, look for 2 legs down. The first leg down was probably just really a complex first leg down. And then we have a pullback and then a second leg down. And there's a very big bear breakout. And whenever you see a very big bear breakout and you're in a trading range, especially if it's a second leg, 1 pullback, 2, you got to be thinking it's a trap, a second leg trap. So instead of this leading to a bear trend, you got to be ready for a reversal. And then once you get a reversal and you have a second leg trap in a trading range, you're probably going to remain in a trading range. So, nice reversal, but I think you had to expect a scalp. And yesterday, from 50 bars, we were in a very tight range. We briefly broke to the upside, briefly broke to the downside, but in a trading range. Bulls hoping that this is going to be the low of the day. Yesterday, bar 1 was the low of the day. 20% of the time, about once a week, the first bar is either the high or low of the day. And yesterday we had a gap up from the close and a very good bull bar closing near its high. I typically don't buy above that bull bar. If it's a gap up far above the moving average, I like to see 2 consecutive bull bars and then buy. So I would not buy above 1, but theoretically it's on a buy signal above 1. In bar 2, the bears were hoping this was a bull trap and that this was the sort of a bear trend, like a lot of times the market will do this, a similar thing 2 days in a row. So rally, reversal, but the reversal did not go below that low, and we rallied. And here we have consecutive bull bars, with one of them closing on its high. So bar 2 here is similar to this. We have a bear bar closing on its low. Because bar 1 did not close near its high, I did not buy above that. And then this I thought was a credible sell. Then we had a second reversal down. So this was a bull trap, and it led to a bear trend. This was a bull trap. It led to a trading range, and the bears could not break below the low this far. So theoretically, this is a weak buy. So some bulls bought it. I thought it was better to buy above this or even wait for the breakout. And what happens is you have a buy signal bar and a sell signal bar. And neither one is all that good. It's a big gap up. I'd like to see 2 buy signal bars. And it's a reversal down, but I'd like to see either a bigger body or the bar closing near its low. So it's not a very good sell. So the market's deciding. To me, I thought if I'm looking at those two, it's more likely on the buy. The bear is trying to get a second reversal down here, but they could not break below this low. So theoretically, the bulls who bought above 1 had to stop below 1. The bears who sold below 2, the bulls who bought above 1 had to stop below 1. The bears who sold below 2 had to stop above 2, and we're in breakout mode. Traders would sell on a stop below 1, and they buy on a stop above 2, and that's what took place on 9. I say they'd sell on a stop below 1. A lot of traders would wait. It's so close to the moving average, a lot of them would wait to see if we broke below the moving average before they sold. So the bears might wait for 2 closes below 1 and then sell, but the bulls would buy on a stop above 2 because the bears would give up. And we had a big bull bar closing near its high. So now we have 2 consecutive bull bars, at least one being big, closing on its high. It's by the close. If you want, you can wait for 2 closes above the breakout point and then buy the market here. 2 ways to draw this is a triangle. We have a lower high, a slightly lower high, and then we have higher lows. So you can view that as a triangle. And then we have a failed bear breakout and a reversal up. Or you could say the triangle is 1, 2, and 3, and then a bull breakout. And then the bars were not all that big here. We accelerated up here, 12, 13. So probably we'd get at least one more leg up, and we did. So you had to be expecting a reversal. We had a micro double top. We have a weak sell signal bar 19, but a micro double top makes it a little bit better. Incredible sell, but most likely when you have a strong rally and a reversal, 60% of the time you're going to form a trading range for at least a couple hours. So this is not a major reversal, it's a minor reversal. Theoretically, this is a lower high major trend reversal, but it's a doji bar and it follows 3 bull bars. So to me, that's really probably not going to be a major reversal. And sideways for the rest of the day. Okay, so we have a big gap down, and we have a bull bar closing near its high, and the moving average is way up here. So there's room. So it's a reasonable buy above 1. But with all the trading range trading that we've had lately, a lot of traders will wait to see if we get consecutive bull bars. We're right at the Globex low. The low of bar 1 is exactly at the Globex low. This is the 15-minute Globex chart, and we have a series of bear bars. So at the moment, it's more likely we'll go below the Globex low than it is that we'll go above the Globex high, the blue line up there. So on the Globex chart, it's not a very good buy. This is the 15-minute Globex chart. We know 90% chance we're going to break either below this blue line or above that blue line. So and we're much closer to this line, and we have good momentum down, and we don't have any kind of a double bottom yet. So chances are this reversal up is not going to go very far, and we'll come down here. But if we get a pair of big bull bars, or 3 or 4 big bull bars, then we'll probably break above the Globex high and not below the Globex low. But right now, it's more likely we're going below the Globex low. You can see the buy signal triggered when 2 went above 1. But what happened? Did we race up? Did everybody start buying? No. There were as many sellers as there were buyers. As many traders thinking it's a bad buy and therefore it's a sell. So there were as many bears with limit orders at the 1 high selling as there were bulls buying. Bulls trying to get a second bull bar, even a small bull bar, even a doji, just the absence of a bear bar, would increase the chances that we're going to go higher. Close the gap below yesterday's low, maybe below this 48 low, get to the 60-minute moving average, maybe all the way up to the 5-minute moving average. Open of the week. So right now we're just about where the week opened, which was yesterday's open. Here are other magnets. I pay attention to all these things. Here's the top of that gap. Here's the gap on the daily chart. And on the pink line here is the bottom. There's the top. And on the pink line here is the bottom, there's the top. This is a 60-minute chart, and I'm just moving my text closer to where the market, closer to today. Another gap up there, back to a 5-minute chart. So we have consecutive bull bars, at least one big and closing near its high. So this is theoretically a buy the close bull trend. So you can be long, stop below 1, or you could buy above 2 and stop below 1. Well, I think it's probably better to be flat. If 2 looked like 1, and we had 2 big bull bars, I think more traders would be willing to buy the market or buy on a stop above 2. Can you sell below 1? No, because if we drop below 1 here, you're selling below 2 bull bars, and you're far below the average price. If you're going to be selling far below the average price, you want the bars to look far above average in terms of bearishness. And if 2 of the first 3 bars are bear bars, if 2 of the first 3 bars are bull bars, that's not very bearish. So you don't want to be selling far below the average price unless you're getting more bear bars. So you can see the market is getting drawn up to the magnets above. First, we get above yesterday's low, which we probably will do. Open of the week is always important. This breakout point, 48 low, is important. The 60-minute moving average is important. The 5-minute moving average, we can get there 2 ways. One is by going up to the average, and 2 is if we go sideways for about 15 bars in a tight range. If we do this for 15 bars, this average will come down here. It's based upon the 20 most recent bars, and if 15 of those bars are down here, that average will be down here with these bars. Right now, this average is based on 17 bars here and 3 bars here, and therefore the average is up here around those 17 bars. Very often the market tries to do something today that it did yesterday. Yesterday, as I said, it had an open similar to the day before, a breakout, a bull move on the open. The day before, Friday, the bull move was a trap and the market sold off. And yesterday, the bull move was, in fact, the start of a rally. And here we got a bull move on the open as well. Can this be the high of the day? Yes. Do I think it's going to be the high of the day? Well, first part of the day has a 20% chance of being the high or low of the day. I think we're going below 1 at this point because I think we have to get below the Globex low. So I think we're going below 1. But does that mean 3 will be the high of the day? No, I think 3, if 3 closes on its low, I would say it have maybe have a 25% chance that it will remain the high of the day. 75% chance we'll go back above the 3 high at some point. But if we get 2 big bear bars, 3 big bear bars, 4 big bear bars, then the chance 3 will remain the high of the day will go up. We saw that the other day. Is 3 going to be the high of the day? Well, maybe 25% chance 2 is the low of the day. And now 25% chance 3 is the high of the day. And then once we broke below 2 and the bulls gave up, then maybe 30 or 40% chance this will be the high of the day. Then after 4 bear bars, a big bear bar closing on its low, closing below the low of the prior bar, maybe 50% chance we've seen the high of the day. And then here, maybe 60 or 70% chance we've seen the high of the day. The more bars into the day we are, the higher the odds are that we've seen either the high or low of the day or both. Yesterday, by the close of bar 19, we saw both the low of the day and the high of the day. By the close of bar 1, 20% chance we've seen the high or low of the day, depending on context. Here, it's a big gap down, so there's a chance, and it's a bull bar closing near its high, so maybe 25% chance this is the low of the day. And the opposite is true if you have a big gap up and then a bear bar closing near its low. If it's a very big bear bar, it could be as high as 30% chance that it will be the high of the day. And the same here. If this was a much bigger bull bar, especially if it was further down, there would be a 30% chance it'll be the low of the day. So bar 1 has every day between a 20 and 30% chance of being either the high or low of the day. Bar 3 looks like 2 yesterday, and yesterday was above the average price, which is a magnet, and we did not break below 1. Here, what's the magnet? Well, the Globex low and yesterday's close. As I said, chances are we're going to go below 1 because it's the Globex low, and chances are we're going to go below the Globex low. But I'm not willing to sell below 1 because if 4 goes below 1, 2 of the first 4 bars are bull bars. Yet I'm being asked to sell far below the average price. And if 50% of bars are bull bars, that's not above average bearishness, so I don't want to be selling here. I need to see maybe a couple closes below 1 before selling. Bulls are hoping that this is like yesterday, that we have a bad sell signal bar, yesterday bar 2, and that we form a higher low, and it becomes the low of the day. To buy above 4, the bulls will want as bullish a bar as they can get. Yesterday, 8, because of the context, I thought it was a reasonable buy above 8. But if we get a bar that looks like 8 over here, I think you'll get fewer bulls willing to take the buy. Just not enough bullishness plus the Globex low, magnet below. What happens if 4 becomes outside up and breaks above 3? Then the bears who sold below 3 will exit, and that will increase the chances that we go higher. But I would not buy on a stop above 3. I'd like to see a close above 3, and preferably a close far above 3. So if 4 becomes an outside up bar, I don't want it to be simply an outside up bar, right? Sometimes you get an outside up bar, goes above 3, and then closes back in the middle. I don't want that. So I want to see an outside up bar like we had last week, if I can find one. I had a really good one. The days pass so quickly. Yeah, here. Okay. We're below the moving average. We're below yesterday's close. Okay. And we have an outside up bar. It went below the low of the prior bar. It went above the high of the prior bar. But not only did it go above, it went far above, and it closed near the high of the bar. So that's a really strong outside up bar. Also, there's a wedge here. Doesn't really look like it, but we have 3 attempts up. We were up here, it failed. Up here, it failed. And now this is the 3rd up. So this is a wedge on a smaller time frame chart. So you get a wedge and you get a strong reversal up. If you want, you could wait for the breakout above bar 1. You could wait for consecutive bull bars closing near their highs. But somewhere in here, it's by the close. And if we get a bar like this today, the same will apply. And so far, we do not have a bar that looks like that. A big bull bar closing on its high, closing far above the high of the prior bar. 4 bars, each of the bars overlaps all the other bars. So it's a sideways open. Similar to what we had here for 50 bars. A lot of sideways bars overlapping the bar before, several bars before, 10 bars before. Consecutive bear bars, but neither one closing near its low, and we have not broken below 1. So not very good sell to close. Also, only 2 of the first 4 bars are bear bars, so it's not all that bearish. yet you're being asked to sell far below the average price. So not a very good sell and not a very good buy. So you have to wait for more bars, more information. Bond market, of a daily chart. Very big bear bar. I'm going to look to buy. If we break below this low, I'll look to buy somewhere below that low, not far below. This is the daily 30-year bond chart. And here's one of the problems that the bulls, or that everybody has. You got prior lows. And we're right at that low. Then we have a breakout point over here. This is the monthly chart of the 30-year bond. Now, we have a bull trend. So getting a gap is not surprising. You get a breakout, a reversal attempt. There's a gap between this low and below the break and the breakout point. We had another attempt down, but this low held above that. So we have a gap. And getting gaps on the way up in a bull trend, that's not surprising. But once a bull trend ends, you either are in a bear trend or a trading range. And if you're in a bear trend or a trading range, the market tends to close gaps. So we have a bull gap here between this low and that high, and the market is going to close it. I don't know if we're going to close it in the next few weeks, the next month or so, but at some point we're going to close it. This is a lot of bear bars, 6 consecutive bear bars plus bigger bear bars. So we're probably going to bounce. We'll probably bounce for a month or two sometime soon. We'll probably do that. Or it could go sideways to up for 5 or 6 months. So we're going to bounce soon, but we may wait until we close this gap before we bounce. And I would not be surprised if the market gets down here around par, around 100, and then rallies for a couple of years, 2 or 3 years. Just like here, we had a sell-off, and it lasted 2 or 3 years. Here, we had a sell-off that lasted a couple of years. On the way down, we'll get rallies that will last 2 or 3 years. So I wouldn't be surprised if maybe we get 3 legs down, 1, 2, and then bounce, and then 3, and then rally back up here. Remember, I still believe we're entering a recession sometime next year. And if we do, the Fed will cut short-term interest rates, and that will result in long-term interest rates falling as well. And the economy will be very slow. No one will want to borrow, and the banks will have money to lend, and the only way they can lend it is by lowering rates. The government will have bonds they have to sell. So I think we're going to get a bounce that'll last at least a couple of years. But I think it's not really going to, we're not going to get a major reversal on the daily chart. Here's the daily chart. We're probably not going to get a major reversal until it's closer to a recession, which I think will be next year. Okay, we just broke below the Globex low. And on the 5-minute chart, this might be a third consecutive bear bar. So is it sell to close yet? It depends. If 5 is big and closes on its low and closes below 1 and closes far below 1, traders will start to short. They'll sell to close of 5. They'll sell on the stop below 5. However, if 5 has a conspicuous tail on the bottom, and if it closes above the low of 1, you'll get far fewer traders willing to sell. The bears are hoping that this is the start of a big bear trend, and the bulls are hoping that this is just a pullback. Okay, so for the bulls, we had an extremely strong rally, and then a deep pullback. The rally tried to resume here, and the bulls are hoping that this is just a continuation of the pullback from this very strong rally. So they're hoping the market just goes sideways, fails to go down all that far, and then the bulls will do this again. Close below 1. Now, the bulls are hoping that we're going to get a reversal up, that the breakout below 1 will fail. and that this will become a lower low double bottom. 5 is below 1, and if we reverse up, it'll be a lower low double bottom, and they'll hope it's the low of the day. But after 3 bear bars with decent sized bodies, and one of them closing fairly close to its low, even though it's a second reversal up today, most bulls will not buy above 6, unless it's an exceptionally big bull bar. If it totally reverses 5 and closes up here, then I think traders will buy above 6. But anything less than a very strong bull bar, traders are not going to buy. They'll wait. And for the bears, I think it's okay to wait to see if we get one more bar that looks like 5. Next target, the close over here. '60-minute chart, very strong rally. 2 legs down, 1 pull back, 2. The bull trend tried to resume, and it's clear the bulls are not yet in control, so we're still neutral. We may have to come down here and form a double bottom. We may even have to go below it before the bulls buy again. Maybe we have to do a 50% correction of that. Bulls are hoping that we stop going down and we go sideways and then form a head and shoulders bottom bull flag. Left shoulder here, head, and then a higher low here. And they hope it's a series of higher lows and higher highs. So a high and then a low, a high, a low, high, low. They're hoping that we channel up. For the bears, it's a double top. And they want to break below the neckline, and they want the market to sell off for a measured move down. Right now, trading range for several days, and traders do not want to sell too low, and they do not want to buy too high. Even with these bull bars, there were not a lot of traders willing to buy up there. Instead, the bulls took profits. The bulls have bought down here, and bears started to sell, betting that the trading range would hold, and we would get a reversal down. Daily chart, banks are starting to report. And Goldman Sachs, I think I read this morning that they had a good earnings report. This is the daily chart, but not much reaction. Bank of America, same thing, good earnings, but not much of a reaction. Monthly chart, Bank of America, and look at where we are. Okay, so here's 25 years ago, and Bank of America's stock is the same as it was 25 years ago. All right, so if you're a long-term investor, all you made was dividends, and it doesn't pay much in dividends, so you did not make much money. So if you bought anywhere in here, 25 years later, your investment is worth the same as it was 25 years ago. If you bought a house 25 years ago, is your house price the same? No, your house price is much, much higher. Bank of America, a terrible investment. Ford 25 years ago. If you bought Ford 25 years ago, in the market, you have not made any money. And here's the past 20 years, right? So if you bought Ford anywhere in here, you have not made any money. So it's a terrible investment. There are a lot of good trades. So if you bought for a trade, you made money. If you sold for a trade, you made money. But for an investment, you buy in your IRA and just hold forever. It's a terrible investment. AT&T. We're back to where we were 30 years ago. So for an investment, if you bought here and you in your retirement account and held, you have not made any money. There were good trades, so you could buy and hold for a year or two, several good trades, but not the kind of thing you want in your IRA. Walgreen Boots Alliance, same thing. We're back to where we were 25 years ago. So there are a lot of these major companies. Here's the E-mini. If you bought 25 years ago, for $1,000, now we're up at $5,000. So you made a lot of money. But individual stocks, a lot of them were terrible investments. Lots of good trading, buying for a day or two or a year or two, but not for retirement accounts. All right, so now we have a second reversal up. So we have a double bottom, and the second low is below the first. It's a lower low double bottom. But the buy signal bar has a prominent tail, and the body is smaller than the bodies of the three bear bars. Most bulls are not going to buy this. More likely there are sellers above. More likely there are sellers above 6. If 7 becomes a big bull bar closing near its high, it will erase a lot of this bearishness. But I think most bulls will wait to see if that happens, and then they'll buy. But right now, more likely, we're going to get a third leg down. So we gap down first leg, 3 bear bars second leg, maybe a third leg down, and then maybe a wedge. Wedges are common. Yeah, we tried to get 3 bottoms, 1, 2, or 2, and then 3. No, I'm sorry, 1, 2, and then we tried to get 3. Instead, we broke to the downside. So gap up, a wedge down. Very common low of the day, but instead we broke a low and fell for more than a measure move down. Then we had a second wedge here, 3 bottoms, 1, 2, 3, and that led to a rally. On the open, a lot of times the wedges don't look like wedges. It takes time to learn how to read things. Here we got 3 lows, 1, 2, and 3, and we broke below it. The breakout failed, we reversed up. This is 3 legs down, 1, 2, and 3. Even though this did not go above that, it was an attempt up. So you got to be viewing this as a wedge. Some computers will view it as a lower low double bottom, where the second leg down was a wedge. So that was a good buy. Or you can wait for bull bars closing near their highs and then buy. Again, a bull bar, bear bar. So leg 1 and leg 2. Leg 3 and then leg 4, but no good buy signal bars. So you'd wait for this and buy above that, or you'd wait for consecutive bull bars closing near their highs and buy above that. You can say, well, Al, that's entering late. The stop is far below, and you trade small because sometimes there's a lot of profit remaining. So buying late with a stop far below is okay. You just trade small. When I say trade small, I mean trade 20% of your normal size. So if you normally trade 1 E-mini, 20% is 2 micro E-minis. So if you buy 2 micro E-minis here or here, you wait for the next buy signal and buy 2 more, 2 more, 2 more. And at some point, you're up to a full 10 micro E-minis. So if your normal position size is 1 E-mini, you're up to your normal size. And then there's still plenty of profit. You could exit there if you want. A lot of profit. So entering late is always okay. I often enter late. I make those charts at the end of the day. Past few days, I switched from green rectangles to green arrows below entry bars. So if you have a buy signal above this bar, the entry is 1 tick above the high of that bar, and you enter on this bar here. So I put the arrows below the entry bars. You get a bull bar closing near its high, so it's reasonable to buy on a stop above the high of that bar, and you get filled right here. And therefore, this is the entry bar, so I put an arrow below its low. Here, we got a buy signal bar and an entry bar. A bad entry bar, but it's the entry bar. Here, a very good reversal bar. And if we go above it, traders will buy on a stop above that bull bar. So this bear bar was the entry bar, so I put an arrow below the entry bar. And on the way down also, here you got a sell signal below the micro double top. So, and the market triggered it on this bear bar. So this is the entry bar on a stop below that first bar or below the bear bar. The reason why I've switched to arrows, there are 2 reasons. One is, as you know, I'm working on a book, and I'm starting to make charts for the book. And the boxes are hiding too much of the prior bars. You can see if I'm using a color book, if I'm printing the book in color, it's not as bad. You know, red and green, you can see the black and white of the bars. But I'm thinking that I'm going to publish the book in black and white. And so if this was a gray and this is a gray, you know, they're just hiding. It'll hide too much of the chart. So I switched to these arrows. Everything in the book is black and white. If there's an arrow below, it's a buy. If it's a down arrow above, it's a sell. So now we have 2 consecutive bull bars, and 4 of the first 7 bars are bull bars. So that's good. The bulls are owning more bars than the bears. Now the bulls need to start to get bull bars closing near their highs. And the more they get, the more bulls will buy. Remember, with all these bull bars, nobody wants to short far below the moving average. So we have to get to the moving average, or we have to get very close to it. And we can get there by going up or by going sideways. As I said, if we go sideways for 15 bars, this average, which is based upon 20 bars, will be down here with these 15 bars. At the start of the day, first bar of the day, the average is based on 20 bars, and 19 of those bars are up here. So you'd expect the average to be up here with the 19 bars. Becoming increasingly bullish. Now, theoretically, the bulls who bought above 1 exited below 2. And theoretically, we're still in the sell below 3. What's going to happen if we go above 3? Probably bulls are going to buy, right? They had a failed attempt here. The bears got a new low, so the bears are feeling confident. So it's a buy on the stop above 3. You put your protector stop below 6, or you wait to see the close of 8, and if it closes at or above the high of 3, you then buy above 8. Is this going to be a very big bull trend day? Probably not. Most days are not very big bull trend days or very big bear trend days. So, you know, maybe once a week we have a really big bull day. Once a week we have a really big bear day. But 3 times a week we have a day that's mostly sideways. So what just happened? It broke above 3, and did a lot of bulls buy? No, there were a lot of bears selling, just like when we broke below 1. Did a lot of bears sell? No, there were a lot of bulls buying. So limit order trading. Right now, are we always in the long? Yeah, I think you need to see the close of 8, but I suspect 8 is going to close on its high, and the close will be at or above the high of 3, and that will make it always in long by the close. What happens if 8 closes 1 tick below the high of 3? We still could be always in long, but it would be warning us that this might be more of a trading range than a bull trend. How a bar closes is really important. The bigger the bar is, the more it closes on its high. The further above the high of the prior bar it closes, the further above prior highs, the more likely it's a major bull surprise, the more likely it'll affect the remainder of the day. So if 8 closes up here, it probably is a major bull surprise, which means that a bear trend day would be unlikely. It would mean to have a, at least a 70% chance of being either a trading range day or a bull trend day. There's the close. So close far above 7, close near the high of the bar, close above the high of the day, close above the open of the week. So it's by the close, but your stop is here. So 15 points below. If that's more risk than you normally take, if you want to buy here, trade small. And I don't think you should have a whole bunch of different position sizes. I think you have 2 position sizes: your normal position size, and then small. And small is 20% of normal, or something like that. You can have it be 30%, but so if you normally trade 1 E-mini, and for you, if small is 30%, you trade maybe 3 micro E-minis. You buy 3 micro E-minis at the market, and stop down here. If it keeps going up, you buy more, you buy more. Now for the bears, they're hoping for a double top. We have a double bottom, 1-6. They're hoping for a double top. But right now, of the first 8 bars, we only have 3 bear bars, and we have important magnets above the breakout point, 48 low, and the 2 moving averages. So I'd rather be long. Can we get consecutive big bull bars closing near their highs? Can 9 close above or at or above the moving average? If we do, that would increase the chances that we'll go up here. Yesterday's range is not very big. And if you have a day that does not have a very big range and you go below it and you reverse, you're going to be thinking that we may go above the high of the day, and today could become an outside up day. And I talked about how important the close of 8 was. It closed above the high of 1, and it closed near the high of the bar. That's really important. On Friday, I think it was Friday. Yeah, I want to show something here. How you get a wedge bottom, and you got a bull breakout. A big bull bar closing near its high, closing far above the high of the prior bar. Well, what do you notice? It did not close above the moving average. That's important. And the rally turned out to be minor. Here, you got an expanding triangle, different ways to look at it. 1, 2, 3, 4, 5. A micro double bottom, lower low major trend reversal. Every expanding triangle bottom is also a lower low major trend reversal. And a really big bull bar closing near its high. Big enough, I think, so that it should affect the remainder of the day. So it's a major bull surprise. A bear trend at that point is unlikely. But that means it's either going to be a bull trend or a trading range. And it turned out to be a trading range. And look at the close of 51. What do you notice? Similar to the close of 34. Something's wrong. Okay? It's not closing beyond the moving average. Look at the close of 9, below the moving average. Another big bear bar here, 14, below the moving average. Increases the chances we'll go lower. But on the bull side, when you get these big bull bars and you're closing just below the average price, it means the bulls are not as strong as they could be. And it increases the chances you'll go sideways instead of up. So the close of 9 is important here. The more it closes on its high, the more likely we're going to go higher. Right now, we're always in long. And let's see what the close of 9 does. Is it going to close at or above the moving average? If it does, it increases the chances that we'll go up to the next resistance level. That's that August 18th low. That's that breakout point over here on the daily chart. And then yesterday's close and possibly yesterday's high. Remember, on the daily chart, I think we're going higher in the next week or two. I think we'll probably close this gap, maybe get to the top of this SPY climax, 4,500. But at that point, if we stall and get a reversal, we'll have a wedge, 1, 2, and 3. So I think we're probably going at least a little higher. I've said many times that this October low is not the same as this October low. This was a 50% retracement of the rally and expanding triangle bottom, 1, 2, 3, a lower low double bottom, and an exceptionally big bull bar. An exceptionally big bull bar. I think that bar was, 150, 200 points tall. And here, the bulls are hoping that this is the same as that, but it's not. We're not as oversold as that, and the reversal up is not nearly as strong as that. So unless here I said we probably saw the end of the low for the year. And in fact, we rallied for 10 more months. Here, I'm not as confident that this is the low of the year. We may have to get a third leg down, 1 pullback, 2 pullback, 3. Okay, what did I just say about closes? Look at the close of 9. It's below the moving average. However, 8 and 9 are big enough so that 70% chance we've seen the low of the day. So that means that today 70% chance it's either going to be a bull trend or a trading range. If we start to get bear bars, bear bar, bear bar, bear bar, then instead of 70% chance this will be the low of the day, one big bear bar, maybe it'll be 60% chance. Two big bear bars, maybe 50% chance. But at this moment, right now, we've probably seen the low of the day. We broke above 1, and will we come down and test, we broke above 3, will we come down and test that breakout? If we do, traders will pay a lot of attention to what the market does at the 3 high. Will it dip below it? That means that the bears have sold the 3 high and sold more 5 points higher, 10 points higher. We're able to get out, break even on their first sell, and with a profit on their higher sells. And if bears are making money in a bull trend, the bull trend is not as strong as it could be. So it's really important to pay attention to a reversal down. Will we dip below that 3 high? If we do not dip below that 3 high, then there'll be a gap between the bottom of the pullback and the breakout point. That will increase the chances that we continue higher today. You can see profit takers at both moving averages. We probably will test the 3 high. Why? Because look at the chart. When you look at that chart, you say, wow, what a great bull trend. No. You say, wow, we sold off. What a great bear trend. No. Or do you say, that's a whole bunch of reversals. I don't know what's going on. It's really confusing. It's a trading range. Whenever things are confusing, whenever there are a lot of reversals, the market's in a trading range. And when it's in trading ranges, it tends to pull back beyond breakout points. We gap down, we broke below 48, well, we pulled back above it. And on the bulls now, the bulls have a breakout above 3, so we're probably going to test that 3 high. And the bears would like the pullback to dip below the 3 high. They would really like the close of the bar here to be below the close of bar 2. If you look at a line chart, okay, here's bar 2. We have a gap. Now, if we pull back and reverse up, there'll be a gap between this low and that high, unless the reversal down has a bear bar closing below here, and that would be bad for the bulls. So right now we have a body gap, a gap between this body and that high. But if the bodies overlap, this becomes a lot less bullish, and it becomes more likely we're going to be in a trading range. Now, since the odds are we have to dip down and test the 3 high, can you sell at the market we're at resistance, the 48 low, or a little bit above it? We're at 2 moving averages. No, I think it's better only to look to buy. A major bull surprise, any bull surprise, chances are we're going to have at least 2 legs sideways, 2 up. So this is leg 1, and leg 2 may be just a single bar, or maybe just sideways, and then the second leg up. So I think you do not sell here if you're doing anything. If you're long, you might take some profits. If you're flat, you look to buy. Can you buy with a limit order at the low of 10? You can buy for any reason, stop below 6. But if 10 is a reasonably good-sized bear bar closing near its low, it looks like 73. If it looks like 57, bear bar closing near its low. If it looks like 21, I would get out below and wait for the next bull bar closing near its high, like 28, and then buy again. Still buy the market, buy the close, buy for any reason, buy the 10 low, buy more, 5 points below 10, buy at the 3 high. So lots of reasons to buy and no good reason to sell, except to take profits if you're long. Some bulls will buy the 10 high. Others will say, trading range for 5 days, 6 days. Chances are we're going to test the 3 high. So instead of buying the 10 low, they'll place a limit order to buy at the 3 high, or maybe they'll place a limit order to buy 5 points below the 10 low, and then 5 more points down. And for the bears, nothing to do. Now, are the bulls going to buy at the 10 low, or are we going to go down to the 3 high? we're probably going to come down to the 3 high. We may go a little higher and then come down to the 3 high. But given that we've been sideways for 5 or 6 days, the market usually likes to test breakout points. Okay, to be long. This is one of those Walmart trades I sometimes talk about, where if you get really confused and agitated and upset and you're getting, and you just can't handle the stress, and you're trading small enough to have a stop below 6, what you do is you just put your stop below 6, maybe place a limit order to take profits about that same distance up here, maybe 20 points above the high of 8, so 5, 10, 15, 20. So you place a limit order to exit here, a stop order here, have them be bracket orders, and then go to Walmart and come back in a couple hours. And 2 hours from now, it's at least 60% certain we'll be up here, and only 40% certain we'll be below 6. You can see some buying at the 10 low. The next thing the market is going to do is get a close on the 60-minute bar. And traders want to see what it will look like. Will it be a big bull bar closing near its high? Will it close at or above the moving average? That would increase the chances we go up to yesterday's close. Or will it have a conspicuous tail on top and close below the moving average? That will increase the chances that we go more sideways. Always in long will probably stay always in long for at least a couple hours. And we could be doing that and go up for a lot of bars, or we could do this and still be always in long. So we could just go sideways or up, but down is unlikely right now. If you bought small on the close of 8 or above 8, and then you bought more above 9, you might buy more above 11 if it closes on or near its high. Above 11 if it closes on or near its high. We're about halfway to the target. Here's yesterday's high. Here's today's low. And the bulls want an outside up day. They want to get above yesterday's high. Why are we going up? Because there are more buyers than sellers. And why would anybody buy? Maybe it's a parabolic wedge, 1 pullback, 2, pause, 3, or 1 pullback, 2, pause, 3. Why would anyone buy? Because they understand the math. They understand one of two things is going to happen. They buy and it goes up. They can exit with profit. They buy, it goes down. It'll come back up here afterwards. So they buy and they buy more on a reversal up. And then they can get off break even on their first buy with a profit on their lower buy. And as I said, right now, only 30% chance we're going to go below bar 6. And that's why traders are willing to buy high, because they know it's either going to go up and they can make money, or to go down, they can buy more, expecting it to come back up here and form a trading range. So the market is either going to remain in a bull trend, or it's going to convert into a trading range, and less likely bear trend. So it's less than a 30% chance that today would end up as a bear trend day. 8 and 9, it's a big enough surprise so that it probably will affect the remainder of the day. Just like yesterday, this is enough of a bull surprise so that we probably saw the low of the day. The day would either continue up in a bull trend or it would go sideways. Yesterday went sideways. And since we've been sideways for 6 or 7 days, chances are we're going to have a lot of trading range trading at some point today. Now, what happens if 12 is a bear bar, especially a bear bar closing near its low? I would get out of longs. And you short, arguing parabolic wedge, up on 7, down on 7, and then second leg, and pause, and third leg. If it's a bear bar closing near its low with a decent sized body, You could sell expecting it to come down to the 3 high, but I still am really not been interested in shorting. I'm more interested in buying. Where's the next buy? Down here. It's about a 50% retracement, and it's the breakout point. So we may come down there. We're stalling at the 2 moving averages. A lot of the bulls who bought are taking profits. The bulls who bought the 10 low, it looks like they scalped and went up 5 points and came down. So that means a lot of those bulls were happy to get 5 points. So if the bulls are scalping, that means they're less confident that we're going to go a lot higher over the next few bars. So tail 9, tail 10, tail 11, and now we have 3 or 4 bars overlapping, so we're losing momentum. Bulls are less willing to buy on the high, like 8 and 9. Bar 12 is important because it affects the appearance of the first hour. And you can see the market's paying attention to the 60-minute moving average there and here. The bears are trying to get the hour to close below the moving average. It'll reduce the chances that we'll keep going up. And the bulls would like bar 12 to close near the high of the hour and above the 60-minute moving average. Does not look like they're going to get it. Remember, sideways for a whole bunch of bars, so chances are we're still in a trading range, and this is a bull leg in the trading range. The bull leg may go higher, it may go up to the top of the range or even above the range, but we're still in a 7-day trading range. What happens if 12 is a bear bar, but with a small bear body? Do you get out below 12? Second reversal down, I would get out below the bear bar closing below its midpoint, because we may have to come down and test that 3 high. It looks like we probably will. Yesterday we broke above 2, and we did test it. 45 bars later, we dipped below it. Bulls do not want a reversal down. They want this to continue up. So they'd like 12 to be a bull bar, and if it's going to be a bear bar, they do not want it to close in its lower half, and they certainly do not want it to close on its low. So you get bulls buying here, trying to prevent this bar from being very bearish. You remember, as I said, if it has a decent bear bar, if it looks like this when it closes, a lot of bulls will exit below 12. And if you're long, hoping for a big bull trend, you don't want the market to do anything to make other bulls take profits. You don't want anybody selling, and you certainly don't want bulls selling. So the bull computers are buying, trying to prevent this from giving profit takers a reason to exit, to sell out of their lungs. Can this be the high of the day? Sure. Is it a high enough probability to short below 12? Let's see how the bar closes. So reasonable for bulls to get out below 12. They don't have to. They could keep a stop below 6, but not good enough for the bears to short below 12. And 60-minute bar. Look at the close of the 60-minute bar. It's pretty much exactly on the moving average. Here's a 60-minute chart. Okay. Hard to see, but the bar closed just below the moving average. So that's important. The computers did that, and it reduces the chances this is going to be a big bull trend. Sideways for, 6 days, and we're right in the middle third of it, so it may go more sideways. Remember, the bulls want to go outside up below yesterday's low, reversing up, and want to get above yesterday's high. They're hoping this is a head and shoulders bottom bull flag, left shoulder or double bottom left shoulder, and then head or double bottom head. Different computers see it differently, but basically, a left shoulder ahead, and now they want a higher low, and they're hoping it's the first of many higher lows, and that this is a resumption of this bull trend. But that is a disappointing close, a prominent tail and a close below the moving average, and in the middle of a trading range. If we start going down, at some point bears have to short. At some point it becomes clearly bearish, but it's not there yet, so I think it's too early to short. Well, the bulls, 12 high below 11 high, so it's a pullback in a bull trend, but it's a bad buy signal bar. So, most bulls are not going to buy on a stop above 12. They'll try to get a bull bar 13, maybe consecutive inside bars. 12 is inside of 11. Its low is above the 11 low. Its high is below the 11 high. They're trying to get a second consecutive inside bar, 13. If they get it, they'll want a good-looking bull bar, and then they'll buy above 13. If it's consecutive inside bars, but a bear bar, fewer bulls will buy. Right now, there's no reason for the bulls to exit. We have not fallen below a bear bar, 12, and we have not fallen the size of a scalp below a bull bar, 10. So it's still more bullish than bearish. But 12 is a bad buy signal bar, so there probably will be sellers either at the 12 high or at the 11 high, and they'll probably sell more higher. Should you do that? No, it's always in long. You should only be looking to buy until the bears do enough to convince us that the bull trend has ended and that we're possibly in a bear trend. That breakout point is that 3 high. That's the magnet. The market might have to test that. The bears wanted to collapse below the 3 high and fall far below, and the bulls wanted to reverse up around the 3 high. They would prefer a gap. They would like whatever sell-off we get to have a low that is above the 3 high. But they'll still be happy if we dip below the 3 high and get a good buy signal bar. You can see bad sell signal bar 12. There were more traders with limit orders buying the 12 low than there were with stop orders selling below 12. So that's good for the bulls. Can you buy on a stop above? There's a high 1, but it's also a 4-bar tight trading range. So that will reduce the number of bulls buying above 13, but it's okay to be long. It's okay to buy. It's and to sell, I would not sell yet. Do I think we're going to race up here? No, I think we're going to go sideways and possibly down, but we may go a little bit higher first. Now I have a clear possible parabolic wedge like yesterday. 1 strong breakout and 3. So 1 strong breakout and 3. But it's still by the market, by the close, by for any reason. Bulls are going to try to get outside up. They're going to try to get above yesterday's high. Another gap right now. The 15 low. There's a gap between the 15 low and the 11 high. The bulls want to keep it open. If you get 2 gaps early in the day, or 1 gap and 1 body gap, it increases the chances the rally will last all day. Yesterday's low, we went below it and reversed up. Then we broke above yesterday's high, and we went a lot further. So similar to today. So right now we're at this point, the second leg up, 1 pullback, 2, and the bulls are hoping for this, a strong breakout above yesterday's high. Chances are we're not going to get it. A lot of outside up days, below yesterday's low, above yesterday's high, and then we went higher. Reversed up from below yesterday's low to barely above yesterday's high, and then went sideways. Yesterday's low broke above yesterday's high, went a little bit higher. yesterday's low, reversed up, sideways, and then at the end of the day, we went above yesterday's high, and today became an outside up day. A little bit below yesterday's low, a little bit above yesterday's high, and then sideways. So be open to anything. We could go sideways. If we go outside up, we could go far above. Small pullback bull trend. This slide's in the wrong place. I gotta move this. Oh, no, it's okay. Small pullback bull trend. We have a gap between this low and that high. We have a gap between this low and that high. We have a gap between this low and this high. So we've got a breakout and a gap, a breakout and a gap. If you get two or more gaps early in the day, in the first couple of hours, it increases the chances that the bull trend will last all day. Here we got a body gap. We pull back below the breakout point, but the bodies do not overlap. There's a gap between this body and this body, the breakout point. Here we got a gap, and then another body gap, a pullback, but the body of the pullback stayed above the body of the breakout point. So increases the chances the trend will last all day. A gap, pullback, breakout point, body gap, increases the chance it will last all day, or at least a long time. And we have a gap here. And right now we have a body gap. If we broke above 12, broke above 13. As I said, I think we're probably going to go sideways here. Even if we end up going above yesterday's high, I suspect that this is similar to yesterday. Parabolic wedge, 1 pullback, 2 pullback, 3. So first leg pullback, second leg pullback, 3. Even though 6 went below 1, even though the pullback from the first leg up went below the bottom of that first leg up, it's still 3 highs, so it's still a wedge. Bulls, I'd get out below a bear bar closing below its midpoint. And for the bears, I said I would not sell below 12. Would I sell below 15? I would not. It follows a pair of pretty good looking bull bars, 13, 14, 13 closing on its high, 14 big bull body, 14 close above 11. So it's okay to exit longs below 14, below 15, a bear bar closing below its midpoint, but you don't have to. You can wait to see if we get 2 or more bear bars. And for the bulls, it's a bad high 1 buy signal bar. 15 is a pullback from the breakout, so it broke out to a new high today, and we pulled back, and it's a bear bar, plus it's a third leg up. Some computers will view this as 1 pullback, 2 pullback, 3. Other computers will view this 1, 2, 3. But a third leg up in a bear bar, I would not buy above 15. You will start to get bears selling the 15 high, selling the 14 high, selling more 5 points higher. Is it worth doing that? I think most traders should be looking for stop orders and not limit orders. But bear scalpers will sell in a bull trend if they think that there's a high probability that they'll make money. And this is a relatively high probability, especially if you can sell more and sell more, if you can scale in higher. Do the bulls have to get out below 15? I would. They don't have to. Chances are, if we get a reversal, it'll lead to a trading range. They can buy more 5 or 10 points lower. And 80% chance it'll come back to the midpoint between their 2 buys, and they'll be able to exit without a loss. So if they buy more lower, use a wide stop and scale in, only 20% chance they'll lose money. But difficult to do, so most traders should not do that. Just if it reverses down, just wait for a bull bar closing near its high and then buy again. Not a very good stop order sell below 15. So a lot of the bears will wait to see if we get 2 bear bars and then sell. But for the bulls, reasonable to exit and then wait for a bull bar and buy again. If you exited below 12, you wait for a bull bar, 13, and you buy again. Suppose we keep going up, but we do not get bull bars closing near their highs. We just get small bull bars. You have to have a backup way to get long. You either buy above a bull bar closing near its high, like 13, or you buy above the prior high, like on a stop, 1 tick above 11, on a stop, 1 tick above 14. But we're getting a lot of prominent tails here, so it increases the chances that 10 was the start of a trading range. So even if we go higher, we're probably not going to go a lot higher. Yesterday, 13, big tail, 14 tail, 15 tail. Probably not going to go much higher before we go sideways for 10 or 20 bars. Yesterday, we went sideways for the remainder of the day. Still always in long, probably trading range. But if we keep getting bear bars, at some point it becomes a bear trend and you have to get short. We're not at that point yet. So I think the best choice here is flat. But you could still be long with a stop below 6 with the intention of buying more if we come down here and then form a bull bar. Very similar to yesterday. Parabolic wedge, 1, 2, and 3. 1, 2, and 3. And we sold off for a couple legs. And that became a complex first leg, pullback, second leg. And we were sideways for the remainder of the day. I don't know that we're going to do that yet. I think the bulls would like to go outside up. They'd like today to go above yesterday's high. So the bears, look at the close of 17, above the moving average. So that is not as bearish as the bears want. Now we have 2 legs down, 15, and then pause 16, and then 17. So it's a high 2. But the buy signal bar 17 is a big bear bar closing near its low. And we're starting to form a trading range. So most traders don't want to buy in the upper half. So I would not buy above 17. I would wait for maybe a couple consecutive bull bars and then buy, or wait for a strong breakout above 14 and then buy. Or wait to be able to buy lower, wait for it to sell off more and form a bull bar down here, like yesterday, 28. The bulls tried to resume, they failed, we got another leg down, and then we got a bull bar. Limit order scalping, trading range behavior. A lot of traders sold the 12 high, the 11 high, and scalped out. A lot of traders sold the 15 high, scalped out. Some traders bought the 15 low, disappointed by 16. Actually, they may have made money. Let me just check. Yeah, it went exactly 22 ticks. So the traders that bought the 15 low were able to make 5 points. And you got bulls buying below 16, the 16 low, a bad sell, and they scalped out here. Bears sell the 17 high, a bad buy, and they're looking for 5 points. Limit order traders are starting to make money. Buy below 10, buy below 12, sell above 12. So limit order scalping, that's trading range behavior. It's still always in long. And you have a bull bar 18, but most bulls are not going to buy on a stop above 18, a prominent tail, and we have 2 bear bars. So what do? You wait. You wait for it to go up here and form a reversal down with a good bear bar, like 57, and then you sell. Or you wait for it to come down here and form a bull bar, and then you buy a bar that looks like 63, maybe 48, unlikely, and 28. bull inside bar closing near its high. You get some bulls buying again. They're hoping we go above yesterday's high. And the bears will try to keep the trading range going. My problem with, I think it's okay to buy here. We're always in long. But I think we're going to get a second leg sideways to down. And I have two problems with bar 19. You can say, well, Al, you keep saying buy above a bull bar closing near its high, especially if it has a big bull body, which is true. But I also said I'd like to buy near the bottom of the developing trading range, not in the upper third. So it's forcing traders to buy fairly high. That lowers the probability. So you need a wide stop. And what's a wide stop? Is it below 17? I think if you're taking that buy, you need a stop, way down here. So you'd have to buy small. And the other problem with 19 is the tail. Whenever I see a bar with a big tail below, reversing up from the moving average, I want the tail to be far below the moving average and reverse up. I don't like it if the tail, doesn't go much below the moving average. Then I feel like the average has not been adequately tested. Now, I said the bears would want a second reversal down from 15. We may go outside down here. Obviously, a good-looking bull bar and a tight bear channel is a bad buy. So you need more than just the bar to look good. The context has to be good. The environment has to be good. Bear trends, tight bear channel, they often form good-looking bull bars, but they're bad buys. So you need more than a good buy signal bar. Buy signal bar. Good-looking bull bars, but forcing traders to be buying in the top half of a trading range, and that's a low probability buy. What do bulls do? If they're long and 20 closes below, if 20 closes near its low, I think it's reasonable to be flat. And like I said, below 15, I think it was reasonable to get flat. I personally would not buy above 19, so I think it's still always in long, but I think the best choice is flat. Looking to buy either a strong breakout above 14, unlikely, or buy a sell-off that reverses up down here. I think the bulls have a better chance of getting that. And for the bears, since bar 10, how many bars have closed below the moving average? 0. So we've had 10 bars, and most of them touching the moving average, but none has closed below the moving average. So I'd like to see a couple bear bars before shorting. Right now, 20 is the opposite of 19. 19 is a good-looking bull bar, bad context, forcing traders to buy in the top of a trading range, tight trading range. 20, a good-looking bear bar, forcing traders to buy in the bottom of a trading range, right above the moving average. So while it's possible it's the high of the day, I would rather wait for a strong breakout below and then sell lower, or wait for a sell signal bar further above near the top of the range and far above the moving average and then sell. Bulls buying the market. Now, why would bulls buy the market? Because some bulls bought above 19, and they know a lot of bulls will exit below 20, and they know a lot of bears will sell below 20. So they're afraid that if it goes below 20, maybe we'll quickly go down. Bulls do not want that to happen. So if they see something bearish, 20, they buy the market. Now, if you did buy above 19, you're certainly disappointed by 20. What will you do? a lot of the bulls will say, oh, it's not doing what I want. I'm going to try to get out break even. So they'll place a limit order to exit one tick above the 19 high where they bought. Others will say, I don't know, that's really pretty bearish, 20. Instead of trying to get out break even, I'm willing to lose 2 or 3 ticks, maybe a point. And they place their limit order 2 or 3 ticks, maybe a point below their entry. And that's what's taking place here at the 21 high. A lot of the bulls who exited, a lot of the bulls who bought above 19 are so disappointed by 20 that they're just trying to get out with as small a loss as possible. Now we're going back above the 19 high. Will the bulls buy again, or will other bulls buy? After bar 20, I think you're not going to get a lot of bulls buying. I think more likely you'll get bulls selling out of longs, disappointed by 20. So bulls need to get 2 or 3 bull bars or a strong breakout above 14, or they need more of a sell-off and a reversal up lower in the developing range. So I did not buy above 19, and I'm not going to buy above 21. And for the bears, it's a limit order sell. They sell in above bars, not on stops below bars. When the market looks like this, better to do nothing. Just wait. If you're young and energetic and you just can't wait, and you put up a 1-minute chart and trade reversals with stops. In fact, there were not very many. Can you trade the 1-minute chart and scalp for 2 points? Given that the bars are only 2 or 3 points tall, I think you'll have a hard time making a living doing that. Even if you win 70% of the time, I think you're not going to consistently make money. The moves are too small, too many decisions, too many mistakes. Some traders will trade a higher time frame chart, like a 10-minute chart, not a good buy, or a 15-minute chart, not a good buy. So 15-minute traders, they're still on the buy if they bought the close of this bar or above it. They might get out below this bear bar, because if it goes below that bear bar, there'll be a micro double top. But right now, the 15-minute traders are still long. I'm trading the 5-minute chart, and I'm currently flat. I'm willing to sell if we go above and get a good reversal down. I'm willing to buy, but I don't want to be buying too high up. Bulls are trying to get back above 4,000. They're trying to get up to yesterday's close. And if they get there, they'll then try to get above yesterday's high. And they want to close that gap on the daily chart. They'd like to get all the way back up here. They're not going to get there today, but they might get there over the next several days. Good for the bulls so far. They prevented 21 from going below 20. But we're still at the top of a tight trading range. And that will reduce the number of bulls willing to buy above 21, even though we're still always in long. Now, I said that you either buy above a bull bar closing near its high, 19, or you buy on a stop above a prior high, 14. And that's what just happened here. Those stop entry bulls had a stop to get long, one tick above 14, and that's why this bar is bigger. There were a lot of bulls buying one tick above 14 or 2 or 3 ticks above 14. They're hoping for a gap. They want us to get up to yesterday's close or yesterday's high, and the bears will try to make the breakout fail. We have limit order trading here, so the bears sold the 11 high. They did not make money. It had to fall 21 ticks from the 11 high for them to make 5 points. It did not. They sold the 14 high, and they'll sell more 5 points higher, 10 points higher. You can see traders are selling. Who's selling? You got bears selling the 14 high. Some will sell a point or 2 or 5 points above. And you have bulls hoping that 22 was going to look like 8. And when it didn't become big enough, fast enough, they decided to exit. So you have stop order bulls who bought the 14 high, one tick above 14, disappointed that the market did not go up further, and they're quickly selling out around break even. It's usually better to wait for a bar to close and make your decision. If 22 is a pretty good bear bar, if it looks like 57, I think you will get bears selling, looking for at least a scalp down. But anything less bearish than 57, I think bears will wait. And the bulls want a bull bar. They want a bull bar closing near its high. If they can't get it closing near its high, they want a bull bar closing at or above its midpoint and at or above resistance, the August 18th low, 4,400 big round number, and the 14 high. The more of that they get, the more likely they'll go higher. They'll hold long. Bulls, I'd get out below a bear bar closing below its midpoint. I would get out the size of a scalp below any bar, including a bull bar. So if it goes 5 points or 22 ticks below bar 22, reasonable to exit. If it falls 22 ticks below the low of the bar, then the bears selling with a stop below that bar were able to make 20 ticks, 5 points. And if the bears can make money with stop orders, most bulls do not want to be long, and they certainly don't want to have bought near the high. Because if bears can make money with stop orders, the bull trend is not strong. And bulls are only willing to hold long or buy high if they think the trend is strong. So if bears are making money with stops, the bull trend is not strong. The market is probably either a very weak bull trend or it's becoming a trading range or even possibly a bear trend. Do you sense that we're waiting all the time here? We have been for the past 10 bars. We're waiting for the bar to close. We're waiting for more information. That's a lack of resolve. So it means the trend is not as strong as the bulls would like. Is the bar going to close on its low with a big bear body? Is the bar going to close on its high with a big bull body? It could do either one. And a lot of traders are waiting to see if it does one of those two things, and then they'll place orders to go long, to go short, to exit. We're very close to yesterday's close, so we're probably going to go a little bit higher. Today always likes to test yesterday's close if today gets near yesterday's close. That August 18th low is a breakout point. We broke strongly below it. This is the daily chart. We broke strongly below it and sold off. But I said we would get back above it because we've been in a trading range for a couple of years. And when you break below something, it usually comes back beyond the breakout point. The bears have a head and shoulders top, left shoulder, head, and right shoulder. We broke below the neckline. And now the bears are hoping this rally is simply a test of the breakout point and that we'll get a lower high and resume down. The bulls are hoping that the breakout below the double bottom will fail and will rally. And we've been going sideways for 6 days, deciding which is it going to be. Is it going to be a lower high in a bear trend, or is the breakout below the double bottom here going to fail, and will we go up? Every head and shoulders top is a trading range, and every head and shoulders top has a double bottom bull flag. The pullback from the first leg and the pullback from the head forms a double bottom. And we broke below that double bottom, which is the neckline of the head and shoulders top. And now we're back at that double bottom. Traders are deciding, is the breakout below the neckline of the head and shoulders top going to fail, and are we going to go up? Is the breakout below the double bottom going to fail, and are we going to go up? Head and shoulders top fails if we go above the right shoulder, because the bears are hoping the right shoulder is the first of many lower highs in a bear trend. Bear trends need lower highs. If we go above a lower high, the market is no longer in a bear trend. It's either in a trading range or a bull trend. So the bears have their stop up here. If we go down to a new low, their stop will be above the most recent lower high. because as long as the market keeps making lower highs, it's in a bear trend, and the bears will stay short. If it goes above a lower high, it's no longer a bear trend, and therefore the bears no longer want to be short. They want to be short in a bear trend. They don't want to be short in a trading range or in a bull trend. Can 23 close on or near its low? Well, that'll be interesting if it does. We still have a possible wedge with 3, 14, and 23, or with 11, 14, and 23. Different computers see it differently, or with 18, 20, and 23. But you have a bull surprise, 21, 22. Whenever the market does something surprising, chances are it's going to have a second leg. So we have a bull surprise, chances are we're going to try to get a second leg up. But it's bad for the bulls if 23 closes on its low, especially if it closes below 4,400 and below the 14 high. The bulls do not want a big bear bar closing near its low and closing below several support levels. It increases the chances that will go down. So you'll get more bulls exiting and you'll start to get bears selling. Most bears are not going to sell below 23 after seeing 21, 22. They'll wait for 2 bear bars or 3 bear bars, or they'll wait for the market to go sideways and form a micro double top. So bulls, reasonable to get out below 23 if it closes in its lower half. And for the bears, I would not short below 23. You have to get out below 23 and put a stop below the most recent higher low, 17. With all the trading range trading, I would get out below a bear bar closing below its midpoint. Since bar 10, we started to get a lot of bars with prominent tails. That means the market went up, it went down, it went down, it went up. We're getting a lot of reversals, trading range type of behavior. And if we're reversing at the top, we could go all the way down to the bottom and still be in a trading range. So I would get out early. You can always buy again above the next bull bar. If you get out below 15, bear bar, you can buy again above 21. If you get out below 23, you could buy above the next bull bar, maybe 24, 25. Getting near the end of the second hour. And bulls are trying to get a bar closing near its high. And this is that August 18th low. You can see for 6 days we've been testing it. Is this breakout low, that low, going to fail? And is the bull trend resuming? Or is this breakout going to succeed? And this is just a test of that low. The bulls give up and then we get another leg down. Now, can this bull trend last all day? Nope. Why am I saying that? Because the bears are getting too many bear bars. The bears keep coming back. Small bear bar here, and then big bear bar, big bear bar, big body, big body. And if you have a rally where you're getting a lot of bars with prominent tails and good-sized bear bodies, that rally is probably not going to last all day. So that means one or two things can happen. You can get a reversal into a bear trend, or you can just stop going up and go sideways like yesterday. After a major bull surprise 8 and 9, a bear trend is unlikely. We may get down to the 11 low at some point later in the day, but I don't. I think right now I'd say 80% chance 6 will remain the low of the day. As I said, if you keep getting bear bars, instead of 20% chance new low, it'll be 30%, 40%, 50%, 60%. But right now, it's only 20%. I don't know if anybody pays attention to ESPN. If you watch any kind of a sports, football game, basketball game, and you look, there's a thing, you look at that game on ESPN, you look at the box score, there's a tab called Gamecast, and in Gamecast, they have an instantaneous probability of who's going to win. So Yankees, Red Sox. If the score is 6-0 Yankees, and it's the 8th inning, the GameCast will say 95% chance the Yankees will win. But then if the Red Sox hit a grand slam and then load the bases up again, so instead of 99%, it may become 50%. So the probabilities can change pretty quickly. And that's true with trading as well. So right now, 90% chance, maybe 80% chance, we're not going to fall below 6. But if we get this, yesterday 46.47, instead of only 10% chance of a new low, it might instantly become 40 or 50% chance of a new low. But right now, only 10% chance of a new low, maybe 20%. By the close of bar 12, there's a 70% chance we've seen either the high or low of the day. By the close of bar 18, there's an 80% chance we've seen the high or low of the day. By the close of bar 80, there's a 99.999% chance we've seen either the high or low of the day. I have never seen bar 81 make both a new high and a new low of the day. So by the close of bar 80, at least one of those will remain. So either the low will remain the low or the high will remain the high. So with every additional bar in the day, there are fewer bars remaining. So that reduces the distance the market can go. It increases the chances that either this remains the low for the rest of the day or this remains the high. Obviously, right now, it's much more likely this will remain the low of the day. We broke above 14. We saw 22 break several ticks above 14, so it's a reasonably good breakout. And we have a sell signal bar 23, like 20, and the bulls again bought the close. They're trying to prevent a bar from going below the bear bar. So right now we're still on the buy above 21, or the buy above 8 for that matter, if you did not get out below 15. But this is probably not going to last all day. We're near yesterday's close. We tested at 23, but did not quite get there. And the bulls are going to try to get an outside up day. They're going to try to get up above yesterday's high. Sometimes, instead of getting an outside up day, you get an almost outside up day. So it goes below yesterday's low, reverses up, and goes up to near yesterday's high, but doesn't quite go above it. Reversed up from below yesterday's low, then rallied strongly and stopped right below yesterday's high. And if you get a reversal down from just below yesterday's high, you always get out of longs and bears will short, and sometimes you'll reverse down even to a new low. This is true of any support or resistance. When the market races up to a resistance level, if it stops right before it gets there, the market might reverse. Below yesterday's low, reversed up, right near yesterday's high, could not get there, reversed down. So if you get a reversal down from resistance, yesterday's high, or from any resistance, traders will start to sell below bear bars. And here, example, I'm using outside up. We reversed up from below yesterday's low. We rallied for hours right up to yesterday's high, could not get above it. Instead, we reversed down. The bulls, hoping to get above it, gave up. Reversed up from below yesterday's low, rallied for 6 hours, 5 hours, and it got right up to yesterday's high, but could not get above. And the bulls are going to exit below a bear bar, and the bears will short, betting that the test of resistance held, and the market might swing down. Again, it's true of any resistance. I'm using yesterday's high as an example. High one, but not a good high one. Tail on top. So it's still always in long, but most bulls are not going to buy below 24. Some of the bulls have bought the 22 close, disappointed 23, placed limit orders to get out around the 23 close. and that caused that tail 24. And most bulls are not going to buy above 24 or above 23, even though we're always in long. We have a gap. We have a breakout. Anytime there's a breakout, here 21, 22, sometimes a 1-bar breakout, sometimes a 5-bar breakout. But anytime there's a breakout, traders always pay attention to the breakout point. Yesterday, 47 broke below a double bottom, and it reversed up back above the breakout point. Here we broke above the double top, 14 and 20, and we tested the breakout point. We overlapped 14, but the bodies don't overlap. So if you look at a line chart, there's an actual gap between that low and this high. So those gaps are good. Here we have a gap between that low and that high. Gaps increase the chances that we're going higher. Remember, a lot of the institutions look at line charts because they're only interested in closes. So for the institutions, there's an actual gap, even though on a candlestick chart, there's not an actual gap. This low dipped below that high. Limit order bears, some will sell the 24 high. More, if they're looking to sell with limit orders, will sell the 23 high and place a limit order to sell more higher. Are they looking for a trend down? No, it's a tight bull channel. From bar 10, it's a tight bull channel. So chances are, if we get a reversal, it'll be minor. So anybody selling is selling, hoping for a minor reversal, and that means a scalp. Scalpers are looking for minor reversals with the trend or against the trend. Swing traders only want major moves, so they want major trends. By the way, remember I talked about that 9 close. I said if you put a stop below 6 and you bought the 9 close, 60% chance we would go up to a measured move before a new low. Or you could put the measured move at the bottom of the breakout, and we're right there now. So we have some bulls who bought that 9 close. They had a stop below here, and they're taking profits here. If your risk is equal to your reward, it's okay to exit at a reward equal to your risk when the probability is high. And when you have a major bull surprise, the probability is 70%. We're going to go up for about a measured move based upon the height of that breakout. So there was a 70% chance we'd get here before we got here. So it was reasonable to buy that close, go to Walmart, put a bracket order to exit below that or below that, and take profits up here. And to still buy the close, the tight bull channel, we have magnets above. So there are traders who will buy the close, but with all these tails and all these bear bars, a lot of bulls will prefer to buy pullbacks. Well, instead of buying at the high, they'll buy below the low of the prior bar, or they'll buy with a limit order 5 points down from the high. Whenever there's a breakout, you broke out of something, and traders will look for a measured move based upon that something. So here's a trading range. We broke out, we pulled back, we tested. We're beyond that measured move. You know, maybe the trading range is here to here, and that would be the measured move. But at this point, the real target is yesterday's high. The bulls are trying to get an outside up day, and the bears will try to get a reversal somewhere below yesterday's high. Are we close enough for the reversal to take place? Probably not. There's still a big magnetic pull there, and we probably have to get closer to yesterday's high before traders will sell. What happens if 26 is a great looking sell signal bar? Let's say it looks like 20. Will traders sell? Wedge 1, 2, 3. Yeah, you'll probably get traders selling, and you'll certainly get bulls exiting. I would get out. If we get a bar that looks like 20 up here, I definitely would get out below its low. As for shorting, it's a tight bull channel, and we have an important magnet above. The reversal down is probably minor. So scalpers will sell, but swing traders will not. And again, they'll only sell if it looks perfect, because chances are we have to get closer to yesterday's high. How close is close? You know, maybe a couple points or so. So if we reverse down 3 or 4 points below yesterday's high, I think most traders will not take the first reversal down. Tight bull channel, bull bar closing above its midpoint. Still buy the close that I would get out below a bear bar closing below its midpoint. And it's the third leg up, different ways to look at it, 1, 2, 3, or 1, 2, 3. That increases the chances that we'll get profit taking soon. So I'd get out the size of a scalp below a bull bar. So, you know, 5 points, 20 ticks, 22 ticks below 26. Can this continue all day? It's possible, but I think unlikely. Maybe 30% chance it'll last all day. 70% chance it will not. But right now it's still going up. More bull bars, right? But the market's becoming stronger. The more bull bars we get in a row, the more bull bars close near their highs. Remember I showed you that outside up. Very often, when a day goes outside up, it'll go far above yesterday's high. Here's yesterday's high, far above yesterday's high. Here, sideways, but kept going up. Yesterday's high went a lot higher. And that's what the bulls are hoping, and the bears are hoping for the reversal down. Normally, if you're going to get a reversal down at yesterday's high, the rally does not look this strong. So it's unlikely we're going to reverse straight down. If this does end up forming the high of the day over the next 5 bars or so, we'll probably have to go sideways for several bars before we can get a reversal. We have a spike pullback channel, and within that channel we have a spike pullback channel. And spike and channel patterns usually evolve into trading ranges. But right now there's nothing to short. What about the bears who sold the 14 high and 5 points higher? They made money. That went up 5 points higher. They could sell more. It came back below that high. They could get out break even on their first sell and with 5 points on their second sell. And some bears will do the same here. They'll sell the 23 high and sell more 5 points higher. They'll try to sell more 10 points higher. But at some point, they have to give up. They have to conclude that their trade is a loser, and they'll exit. Another bull bar closing on its high, closing above the high of the prior bar. So 25 closed above 24 and above 23, gap between that close and this high, gap between that close and that high. 26 closed above 25, the gap between that close and the breakout point. 27 closed above 26. So we're getting gaps on every bar. And that's a sign of aggressive buying. It reduces the chances that the first reversal down will get very far. In most of these outside up attempts that fail, the trend is not nearly as strong as today. Here's an example that it's similar today, very, very strong, and yet it still failed. But most of the time, this is also pretty strong. But most of the time you have some pullbacks along the way. That's the end of the day. A 1 bar rally and a reverse. This is very, very strong. So traders are buying. They're buying the market. They're buying with stops above the high of the prior bar. They're buying with limit orders, 2, 3, 4 points below the high of the prior bar. They'll buy below the prior bar. They'll buy the 27 low. They'll buy the 28 low. What happens if 28 is a bear bar? Will they buy the low? It depends. If it closes above its midpoint and has a small bear body, they'll buy the 28 low and 5 points lower, or they'll start buying 5 points lower. And continue shorting, arguing, limit order bears made money selling the 14 high, and therefore the bears have sold the 23 high and selling more higher will make money. Normally, when a trend is very, very strong, it was not too strong here, but it's becoming strong again. When a trend is very strong, I don't want to sell. I only want to buy. But I'll be quick to get out, especially below major resistance, yesterday's high. Okay, look at the past several days. What happened at this price? We failed, we failed, we failed, we failed, failed, failed. And the bears are hoping we'll fail again. But when a trend looks like this, normally the first reversal will be minor. You have to wait for a second reversal. When a trend looks like this, normally the first reversal will be minor. 1 bar, 5 bars, and the bears will need a double top. So not a good sell. Here, you can see it had to go sideways for about 5 bars before it could sell off. Outside up day, we went below yesterday's low, reversed up, and we now are above yesterday's high. And we have a couple other targets above. 50% pullback from the September sell-off and the top of the gap. And I think we're going to get up here. I don't think we'll get there today, but I do think we're going to go higher. Now, sometimes when you have a strong bull trend, this was a weaker bull trend and it's becoming strong. Sometimes when you have a strong bull trend, it'll reach targets that you thought were unreachable. And anytime you get a breakout, there's a gap. And I talked earlier about how maybe there'll be a measured move up based upon the height of the trading range. Well, we went a lot above that. And sometimes when you get a gap, the measured move will be from the start of the bull trend to the breakout point. So we may go up here. So this may be the middle of the day's range. Bulls, even though it's very strong, I would get out below a bear bar closing near its low. And for the bears, even though it's a possible failed breakout of yesterday's high, this is too strong. I would not short the first reversal down. So, okay to exit longs if there's a bear bar closing below its midpoint. If it's not a bear bar closing below its midpoint, there probably will be more bulls flying the low of the bar than bears selling. Really good rally. Reasonable to exit longs below 29. Or you could wait to see if we get 2 consecutive bear bars and then exit. The bulls are hoping that there'll be buyers at the 29 low and 5 points lower, and that we keep going up. The bears are hoping that this is a buy climax at the top of a 6-day trading range and the beginning of a reversal down. But with 5 consecutive bull bars and a very tight bull channel, chances are, if we do go below 29, the reversal will be minor. Could be 1 bar, it could be 10 bars, could be 5 bars like that. But whatever reversal we get is probably not going to lead to a bear trend. So whatever reversal we get, there'll be bulls buying the 29 low and or 5 points lower and or 10 points lower at the moving average, at the 24 low. They'll take any or all of those buys, betting that will bounce at least far enough up for them to get out break even if they bought the 28 close. If they bought the 28 close and do not exit below 29 and they wait for a bull bar closing near its high to buy more, 80% of the time it'll get to the midpoint of their 2 buys. That would allow them to get out break even on their trade. 60% of the time it'll go all the way back to the first buy, and then they can get out break even on their first buy and with a profit on their lower buy. And for the bears, this is not enough reason to go short. I would wait for at least 2 bear bars, preferably a trading range and a double top. Can you buy with a market with a limit order at the 29 high? I would not. I think it's good to get out below 29. If 30 is a bull bar closing near its high, you can buy again, but I would get out. This is climactic. It increases the chances that we'll get at least a couple small legs sideways to down. What are the chances that this is the high of the day? Right now, maybe 30%. I mean, 70% chance it's not going to be the high of the day. But if we start to get a series of bear bars, then the probability will be that it's the high of the day. Right now, 10% chance we'll get a new low today. But it's possible that we could reverse all the way back down to the start of the channel. So spike, pullback, channel. High one, but only a small bull body. So that's not going to attract a lot of buyers. The only buyers who buy above 31 are bulls who will put a stop down here and they'll buy more lower, or a stop down here and buy more lower. And for the bears, they're hoping that we get a second reversal down with an even better looking sell signal bar. So they want a micro double top. Some bulls bought the close 28, disappointed 29. They'll place limit orders to get out break even here, 31. If enough do, we'll get a micro double top. If enough do not, then we'll go higher. We have obvious magnets a little bit higher, so chances are we're going to go at least a little bit higher. Okay, are we going to have a huge bull trend that continues up all day? Usually when it goes up really fast, like this and like this, it's testing a magnet and it will go sideways for at least a couple hours. So we should go sideways for at least a couple hours. And this might be the start of it. Maybe we'll go a little bit higher and then go sideways for a couple hours. And then after sideways for a couple hours, the bulls will try to get a resumption up. The bears will hope for a reversal down, maybe a double top. But right now it's bullish. And we should start to go sideways for a couple hours soon. This might be the start of it. Sometimes a bear bar or a doji bar is a sign that the market is becoming less bullish and that it'll start to go sideways. But this is too far, too fast. This kind of behavior usually is a race up to a resistance zone, and then the market goes sideways for a couple hours. So we're probably going to go sideways for a couple hours soon. Maybe here, maybe we have to get up here first and then go sideways. But we're probably going to be sideways for a couple hours, and then bulls will look for a buy signal at the bottom of the range or a resumption up into the close, and the bears will look for some kind of a double top and at least a minor reversal down, a deep minor reversal. All right, I'm going to step aside, and Brad is going to take over. I hope you have a good day.
So we're testing yesterday's high, the blue line. We formed a high one buy on bar 30, and the rally from 24 to 28 was strong enough for a second leg, but it's consecutive buy climaxes. So I suspect we'll probably start to go sideways fairly soon. What are the odds that we get a sharp reversal down, testing back to 43.92, this type trading range? The bears are going to need to do more to convince traders that that will happen. You know, it's kind of like what Al said. If the bears start to get, he mentioned over here, the odds were we'd seen the low of the day. And around bar 24, if the bears started to get 2 or 3 big bear bars, like 46 and 47, the odds would increase for the bears. Right now, the best the bears probably will get is a trading range. And a trading range, that means we'll probably test closer to the moving average. We'll probably try and fall below bar 30. But right here, I think this is a better profit-taking area for the bulls than an area to establish longs. What about buying the close and scaling in lower? Some traders might, but we're at measured move targets. We're at yesterday's high, and this is fairly climactic late in the move. If 32 is a bear bar closing on its low, I think it's okay to exit longs and look to buy a pullback. The bears that sold above 30 scaling in made money, and the bulls that bought above 30 scalped out. Now, just because I think the market's going to pull back, I'm not saying that I think the market's going to reverse sharply. What I'm expecting is overall disappointment. 32, inside bar, but there's probably sellers above and will probably go sideways, similar to how there were sellers above 30. But overall, traders, the bulls, the bears need to do more if they are going to take control. Type bull channel, so first reversal down probably will be minor and lead to a trading range. And the reality is that means that the bulls who buy and scale in lower all the way down to the moving average will probably be able to avoid a loss. What are the chances that we continue to drift up without getting closer to the moving average? I think it's fairly low. So right here, I think there's probably more sellers above 32 and the market's going to pull back. But I do want to stress the bears really need to do more. And because the bears need to do more, I suspect the downside is probably limited. By the way, I've opened the question box on the GoToWebinar, and I'll take a look at that here in a few. You can see bears sold above 32, and they took profits in the bottom third of bar 32. And a lot of traders do that. They'll sell the high of 32, and then rather than set a target at the low of 32 or below it, they'll take profits around the midpoint, betting that it's a trading range bar. You can see on the daily chart, the bulls, they want to get a close above as many bars as possible. They want a strong entry bar, and they want the start of this second leg. I mentioned on the blog that the rally down here that began at the end of the week before, so pretty much last week, these two big bull bars, this rally was strong enough for a second leg. And that's exactly what the bulls want. They want to break out, pull back, second leg. And the bulls are hopeful that this is the start of the second leg. I still think we're going to get up here at some point, and this bar is good for the bulls, but tomorrow is important. Can the bulls get this bar to close on its high, and then can tomorrow be a strong entry bar? There's still enough time left in the day where we can get a fairly deep pullback, but right now, the bulls have done a good job. Hesitation near the high of bar 31. So probably going to continue sideways here. 33, doji, but a close under the 32 high. That's a sign of weakness by the bulls. The bears are trying to halt the buying, but they really need to do more. Someone made a comment. They said that there's not been, up until noon, a single sell signal to get out of a trade. And in part, they're right. And what they're talking about is always in traders, let's say they're long above 21, they buy above this bar. Some traders, they might get out below 23, but the reality is 21 and 22 are strong enough for a second leg. So a lot of traders, rather than getting out below 23, they might get out maybe 3 or 4 points below the bar. And obviously it didn't trigger. Here, same thing, strong enough rally. Some traders might get out below 29. Other traders, they would probably get out 3 or 4 points below the 29 low. And obviously it didn't go 3 or 4 points below, and those traders are still in. I suspect here, with the market beginning to evolve into a trading range and go sideways, you'll have more and more bulls start to reduce their position. Traders are happy to buy aggressively as the market's going up. But once the market starts to go sideways, a lot of those traders start to lighten their position because they know that the odds are the market's going to start to go sideways. I still think the market's going to try and fall below the 30 low. Tight bull channel typically evolves into a trading range, and I suspect the trading range is going to be fairly tight. So somewhere in this area. If 34 is a bear bar closing on its low, do bulls get out? I think they can. The reality is, again, just look at a 15-minute chart. Obviously, a lot of bull bars, but the pullback can be fairly deep. And one of the reasons why I think it's reasonable for traders to get out below 34 is if 35 is a bear bar, even if you get let's say a doji on 35, it'll form a high one buy. And the odds are there's probably sellers above a high one. So if we break below, if 34 closes on its low, let me just find an example, make it easier. Kind of like this. Even if we get a couple bars down, and if we form a high one, traders may sell above it for a small second leg down. So my concern is there's probably sellers around the midpoint of this bar for a brief second leg, and that might entice traders to take profits here. Brief second leg does not mean a major reversal. It just means a second leg and probably a test of the 30 low. See, measured move target from the low of 17, high of 23, projects up to 19.75, and that's exactly where 31 went to. The easier it is for bears to make money above bars, the more the probability will increase for the market to pull back. So tail below 34 lowers the probability of the sell. I still think it's okay for bulls to begin to take partial profits or full profits below 34 and then look to buy again above a bull bar, ideally probably waiting for a small two-legged pullback. Some traders buying the 34 low, taking a chance that they can scalp out near the midpoint of the bar or the upper third of the bar. And for the bulls, they're hoping that 34 looks like 23 and 29 right here. A brief pullback below the bar and higher prices. If 35 is a bull bar, closing just like it is on its high, is it a buy above? I would not. It's a tight trading range, and there's probably sellers above the bar, and the market's going to go more sideways. The bulls are trying to form a breakout and a bottom right at the support level of yesterday's high, this blue line. So here is yesterday's high, and they want the market to find support right here. And they're hoping they can do it with this bar. $34 is a good example of why a lot of traders will exit a couple of points, like 3 or 4 points below a bear bar, especially when the rally is fairly tight. The only problem I have here is when the rally is fairly tight. The only problem I have here is I suspect there's probably sellers above 34 and possibly sellers above 35. So I think the upside is probably going to be limited. Bulls trying to get another breakout. Bears unable to fall 3 or 4 points below any bar. But let's see how this bar closes. Outside bar, 35. That will lower the probability slightly for the bulls, increase the probability of a trading range. I still think the market's probably going to begin to go sideways here. Until the bears get a downside breakout, there really is no breakout. And again, I think we're going to get to the moving average. And there's a couple of ways we could do that. Obviously, the market can go straight down to the moving average. Another way is if the market goes sideways. As I was saying, another way is if the market goes sideways. The longer the market goes sideways here, the more the moving average will get dragged up to the current price level. You can see the tail on 35 above it. That lowers the probability of buying above 35. But the bears are still not doing enough. the bulls want to prevent the bears from getting a bear bar on 36. And the bears, they're hopeful that 36 is a failed breakout above the 31 high. And they want it to lead to reversal down. And the bulls will trail a stop. So some traders, they're still long from down here. And as long as we continue to get bull bars, those bulls will continue to trail a stop until they get stopped out. Another bull bar closing on its high, 35.36. Is 36 by the close? It might be, but again, this has gone on for a while and will probably start to go sideways fairly soon. Sideways does not mean a reversal, but sideways does imply getting closer to the moving average. And I suspect a lot of traders want to buy closer to the moving average. You can see what happened in the first minute of this bar. More traders sold the close of 36 than bought it. They sold it to take profits, and that's a warning that there's not as much momentum into the close. If this was truly very bullish, traders would be buying the close of 36, not selling the close of 36. That makes me think we're going to test the lower and possibly test the 45 low. Possibly test the 35 low. If 37 closes on its low, I think it's okay for bulls to exit. And I really think it's okay for bulls to be flat right here. 37 is big enough that we'll probably get a small second leg down, which means that 38 is a pullback for the bulls or a high one buy. There might be more sellers above. So if 37 closes on its low and we trigger the sell below 37 during 38, and then we form a bull bar around the midpoint of 37, that might lead to more sellers above for a second leg down rather than buyers. I think it's okay to be flat here and exit longs. Aggressive bears may sell, taking a chance we test the moving average. The signal bar is big, 37, increasing the risk for the bears. But I think 37 is enough of a surprise that we'll probably get at least a small second leg down. Bar 38 is a bad high one buy. It's a weak entry bar for the bears, but it's a bad high one buy for the bulls. Therefore, there's probably sellers above 38 rather than buyers. And we'll probably get at least a brief second leg down. And I suspect we'll probably fall below the 38 low. And we'll probably test the 35 low. Whenever I'm trying to decide what to do, or I'm always thinking, let me back up. If I'm in a trade and I'm trying to decide what to do, I'm always asking myself, would I enter above or below this bar? Would I buy above it? Would I sell below it? And I'm always thinking about the always in direction. And that's a really, for lack of words, that's a fancy way of saying I'm always thinking about major reversals. The major reversals are the most important. And think about major trend reversals. The bulls, type bull channel, probably buyers below. So the bears really need a trend line break. They need a strong trend line break, maybe to the moving average, and then a retest. And we know if that's the case, the best the bears are going to get is trading range. I think it's reasonable for the bulls to exit below 37. And because of that, 37 is more likely to be a minor reversal lasting a couple of legs. It's not going to be a major reversal because major implies opposite trend. But it could easily be a minor reversal testing the moving average. So whenever I'm looking at a chart, I'm always trying to find the dominant feature of the chart. Here, bar 8 and 9, clearly always in long. So you can buy for any reason, stop down here, and you're probably going to get some kind of measured move and a second leg up. Weak entry bar, weak follow through, micro double bottom, 38, 39, probably sellers above, and I think we're going to get to the moving average and test the 30 low. So I'm not all that thrilled about buying above 38. If anything, I suspect I'd rather sell above 38. But you're getting in the buy zone for the bulls. And because of that, if there's sellers above 38 and there's buyers not far below, you know you're in a trading range. 39, 3 consecutive bear bars increases the probability that we're going to go a little bit lower. And there's probably sellers above. The bulls, they want a double bottom with micro double bottom with 38 and 40. But with this tight of a channel, I suspect we're going to test the moving average. This is what I was talking about in here. A lot of traders don't want to buy because they want to buy a test of the moving average. This is strong enough that there's probably sellers above and it will probably form a lower high. And that's in part why the market is getting vacuumed down. What about selling right now at the market? Some traders might. My only problem with that is it's really common for pullbacks to become fairly strong, where you look at it and you say, yeah, you know, the market's probably always in long. I think I'm going to buy. But let me back up, where you say the market's always in short. I think I'm going to sell. But when you look at it, you think to yourself, yeah, I don't know. I think it's always in short, but if this bar has a tail or the next bar is a bull bar, it's probably not always in short. That's usually a warning that the market's in a trading range. So whenever you look at the market and you think to yourself that the bulls or the bears need one more bar to make it clearly always in long or clearly always in short, that's usually your radar telling you that you should wait for one more bar. What about buying the 40 close, betting that the bulls will not get one more bar? I think that is really not ideal. With this tight of a channel, we could easily break below the moving average. I think a lot of traders should really focus on stop entries. And the reason for that is it simplifies things. If you look at Al's charts at the end of the day, by waiting for a stop entry, you're really simplifying your trading. Bar 1, you either buy above it or do nothing. Bar 3, you either sell below it or do nothing. Bar 6, if you don't buy above 6 because of the tail, wait for the breakout. Buy the close of 8, put a stop below. Buy above, or buy the close of 9, stop below. Buy above 13, stop below 13, stop below 9, stop below this bar, bar 8, any of these bars. The bar is getting stronger. That's good for the bears. What about selling the close? I don't know. For me, it's the first bar below the moving average. This is good for the bull. This is good for the bears. You know, if we think about that major trend reversal discussion, we have a bull trend. We have the trend line break. So the bears are growing in strength. What we don't know is this going to be a trading range, or is this going to be the start of a bear trend? So if it's a trading range and if it's a bear trend, the pullback could be all the way up here. In general, for me, whenever I see a breakout, I like to think of it as kind of like an always-in flip. Whenever I see a breakout below the moving average and the market's been above the moving average for a whole lot of bars, I'm really more prone to waiting to see, can the bears get consecutive, can they get 2 or 3 closes below the moving average? The first time the market touches the moving average in a lot of bars usually leads to sideways and a pullback. So to here I think there's buyers below, but the buyers are probably buying for a scalp. And the reason they're buying for a scalp is because there's probably sellers above any bar. And I'll talk more about this, but as far as stop entries, one of the great things about stop entries is you can contain your risk. A lot of traders, they look at Al, they look at other traders who use wide stops and scale in and scalp, and they get the logic. You know, they understand the fact that they can buy below 3, scale in, and make money. But the problem they have is they sell above a bar like 6, and they're unable to exit the trade. You know, even if they exit here, it's not ideal, but it's so easy for traders to get emotional, sell above bar 6, and then just be in denial here. And then they can't exit the trade, and they end up blowing their account. By waiting for stop entries, really, another way to think about that is by trading the always-in direction. If you force yourself to trade the always-in direction, here it's clearly bullish, only look to buy. Here it's probably more bullish than bearish, so look to buy pullbacks until you get a major trend reversal. If you do that, you're going to have an easier time not getting trapped in the wrong direction. So look what just happened. The bears failed to close below the moving average. And the reason for that was there was more traders buying down here than selling. What about selling if this is a bear inside bar? I would not. This is at the moving average, and this is probably the buy zone. And the reality is the market's probably going to rally somewhere up here. We have a bull trend, trend line break. The odds are we're probably going to try and form a lower high major trend reversal. For the bears, they'll see the tail as a pullback. We go to a 1 minute chart. See if we can see it on a 1 minute chart. It's a little bit easier to see. Maybe a 2 minute chart. This is easier to see. You have a bear breakout, one bull bar, and then a retest. So that one bull bar here is the tail on this bar. So some bears, there was some bear who, unfortunately, they ended up selling the low of this bar. And they're going to scale in higher on the close of 40. So what are they going to do when the market retests their average entry price? Those traders are going to buy back their shorts. And the bulls know that. So the bulls, they're going to start buying and scaling in, betting on a pullback. So I think we're probably going to try and go above the 40 high. And the reality is, I think we'll probably try and test the 36 low. This whole thing is probably a trading range. It's easy to look at it and get hopeful that this is the start of a bear trend. But when I look at this, I see a large trading range. And whenever I see a trading range, I'm always thinking disappointed traders. If I'm a bear and I'm selling down here, I'm going to face a deeper pullback than I want. If I'm a bull and I'm buying high, I'm going to have to hold through a deep pullback. The sell-off to 40 was not enough to make the market clearly always in short. And because of that, the pullback could be fairly deep. But I do think the sell-off was strong enough to make the market a trading range, which means even if we get above the 37 high, there's probably more sellers above rather than buyers. What about buying above 41 if it's a bull inside bar closing on its high? Some traders might, but with the micro channel lasting about 5 bars, maybe 6, I think there's probably sellers not far above. It was reasonable for the bulls to buy the low of 36. And because of that, you know what I'm going to say. Bulls that bought the low of 36 and scaled in, guess what? It's a trading range. Trading ranges are forgiving for limit order traders. And that means we're probably going to test this red line. We're probably going to get to the 36 low and allow those traders who bought and scaled in out with a profit. A lot of times, whenever I think there's a trend line break and I expect a second leg down, but I think the market's in a trading range, I always look for breakout points. So I'm always looking for, let me move this so it's not too distracting. I'm always looking for a breakout point like the 36 low. Rather than selling here, I'll look to sell higher. My only reservation selling right here is it's at the moving average. So for the bulls, the target for the bulls, remember what I said all through here, going sideways? I said the odds are it's probably going to form a trading range, and we're probably going to go sideways to the moving average. And I made the comment that we're probably not going to get a strong, we're not going to get a major reversal down, but we'll probably get a minor reversal in a test of the moving average. This is that minor reversal, forming an expanding triangle. So the market's deciding right here. You know, a lot of expanding triangles, the reason why they're major trend reversals is because they're a series of trend line breaks. Trend line break, new high. Deeper trend line break, new high. So a lot of major trend reversals, if you think about reversals as a whole, the market repeatedly tries to reverse the breakout. However, it usually fails and the pullback has to get deeper and deeper, like right here. Technically, this is an attempt at a major trend reversal. We broke a trend line and went to a new high, but it's so minor relative to the rally that the reversal needs to get bigger. Here's a bigger trend line break and then a new high, but this is still minor. and eventually you start to go sideways for enough bars, it becomes more important of a trend line break, but it's still minor relative to the overall trend. Same thing here. We can draw, if you go to Al's books, you'll see he draws a series of trend lines in all throughout the book, and they get steeper and steeper, but eventually you get something that's meaningful. And usually a measure of what's a meaningful trend line break, you can use the moving average. That's why Al talks about you want a 20 gap bar buy or a 20 gap bar sell. You want the market to close under the moving average because that's a sign of strength. Here, we reached the moving average, but why didn't the market close under the moving average? Why couldn't we get a bar completely under the moving average? So the odds that this, you can, where I'm getting at is, even if this is a lower high and we break below 40, it's probably part of the trend line break. In other words, it's just forming a steeper trend line break, and we'll test up here. You had some of the traders who bought the 36 low and more lower. What are they doing right here? They scalped out. Some of the bears who sold down here and scaled in, they're probably going to use this to buy back their shorts. So overall, I think we're going to be sideways for some time. As far as the 15-minute chart, we have a strong rally, but a very deep pullback. So what do I think is going to happen here? Well, if this bar closes in, 2 minutes. And right now, we're getting a fairly big bar. So we're breaking to the downside. Give me one moment. Right now, we're getting a little bit of a surprise, and that increases the risk that we're going to go lower. What about selling the close of 42? Some traders might, but I think this is probably going to lead to a trading range overall, so I'm not all that thrilled about selling down here. The bears want 42 to be a strong enough breakout below the moving average to lead to lower prices. But I think the bears need to do more. 42 is an outside bar. It's a little bit of a surprise, but it's a possible second leg down from 40. If 42 closed this bar below 40, that will increase the probability of lower prices. But just look at the bar. Do you feel urgency to sell the close of 42? Or do you find yourself waiting to see if the bar is going to close with the tail, if it's going to close on its low? And right now, the odds are this bar is going to be a trading range bar. And the bulls that bought above 41 and scaled in lower are probably going to make money. Back to the 15-minute chart. Consecutive bear bars, bulls that bought the low of this bar or the prior two 15-minute. Let me do this. Bulls that bought below either this bar or this bar and scaled in, they're probably disappointed by these two bars. And that means that the first reversal up will probably fail. So there's probably sellers somewhere around here, 44.15, maybe the low of this bar, the 11:45 Central Time 15-minute bar. What do bears do if 43 is a bull bar closing on its high? You'll have more bears look to get out. Consecutive bear bars, 42, 43, that will lower the probability for the bulls buying here. Still probably a trading range, most likely, but I suspect a lot of bulls would like to buy above a bull bar, and this channel down is getting a little too tight. If 44 is a bull bar closing on its high, you will have more bears exit, betting that will form a trading range. But with 42 and 43 being consecutive bear bars, that will limit the upside. Bears trying to get a downside breakout, but with the channel up being as tight as it is, I suspect we're forming a trading range. It's possible this is three pushes down, 40, 42, and then 44. If we get a bull bar closing on its high, I think bears should look to exit. We could easily rally and test near the 41 high. As bad as 41 was to buy above it, it was not the world's worst buy. It's at the moving average. It's a bull bar. It's a micro channel, lowers the probability for the bulls. But when you look at this, just ask yourself, if you bought above 41 and then you scaled in and bought more above 44, do you think you'll make money? You probably will. And to me, this looks like a trading range. The bears, they did really good. They got an inside bar, bear bar closing on its low, but then they got a bull bar. And it's easy, and trading ranges are always making traders hopeful. What I mean by that is trading ranges are notorious for making you hope that you're getting a bear breakout. And then, just when you think the market's about to be successful and break out to the downside, you get a reversal. You get a bull bar like 44. So to me, I think always in bears exit above 44, and aggressive bulls might buy. Other bulls will say, yeah, the channel's pretty tight. I'll wait until we get 2 or 3 consecutive bull bars. We have a 20 gap bar buy completely below the moving average. That will entice other bulls to start buying. But we've been in a bull trend. We have a trend line break. We're probably forming a trading range. And if I forgot to mention it, bar 41, the high of that bar is probably a target, as is the low of 36. So we could easily rally all the way back up here. But I suspect we'll probably break a trend line, so we'll rally for a few bars, pull back, and then maybe try and rally somewhere up here, somewhere between 44.15, maybe 44.18. So let's see. Good bull bar 44, but what's 45 going to look like? The bulls need to overcome the tight bear channel. You can see it right here. Consecutive bear bars. Even if we get a bull bar closing on its high, the reality is there's probably sellers above. So I suspect we're probably going to rally and form a lower high. I think it's lower probability that we rally and break out to a new high. Some traders bought the close of 36 right here, and they're obviously disappointed. They bought the close of 36. Some of those traders, instead of getting out below 37, they'll buy the close of 36, and they'll buy more above a bull bar like 44. And look where the midpoint of the prices are. Bulls buy this close, 36. They buy more on a stop above 44. Break even on their entire trade is somewhere around 44.16. That makes me think we're going to go above the 41 high. Bears are doing a good job of preventing the bulls from triggering the buy on 44. So they want to continue the tight channel. They want to create open gaps. Low of 36, low of 37, high of 42, and maybe one of these lows, 41, 40, and the high of 44. It's possible that bulls used 44. Bulls bought the low of 41, bought the low of 40. They scaled in lower. They used 44 to sell out of their longs. But I still think the bears need to do more here to create the argument that we're going to get a downside breakout. If 45 is a big bear bar and then 46 is another bear bar, probably always in short. And we might be always in short right here, but my only concern with saying that it's always in short right here is if we get a bull bar closing on its high, that might cause bears to buy back their shorts, betting on a trading range. Bears trying to get an endless sell-off. The channel down's tight, but look at the sell-off. Sell-off, rally. 2 bear bars, bull bar. Bear bar, bull bar. Another bear bar. Probably, the bears are probably going to get disappointed. Bears trying to get a breakout here, and they might get it, but let's see how this bar closes. Okay, bear bar closing on its low. Good for the bears. Are we always in short? I think so, but my concern is the bull bars. If the next bar, if 48 is a bull bar closing on its high, then unfortunately the bears that are short probably have to buy back their shorts. So here, I think the bears need one more bar. Look what happened on 48. As soon as the bar closed, everybody bought it. And that's a warning and a reminder that this is still probably a leg in a trading range. Whenever you're trying to find support, it can be helpful to look to the left. Here's a breakout point, and 47 tested the high of 43. It's possible we go a little bit lower and test the high of 24. Because the channel down is so tight, the first reversal up is probably going to fail. Breakout 42, a little bit of surprise with follow through 43. So we had a leg 1, second leg 44, third leg 48 or 47, 48. If 48 is a bull bar closing on its high, I think it's okay for bears. I think it's reasonable for bears to exit. The bears are trying to get follow through selling after 47 with 48. But let's see. You can see it best on a 15-minute chart. When you look at this, does this look like the market's always in short, or does this rally look more important? To me, the rally looks more important. So this sell-off, as strong as it is probably going to start to go sideways soon. And that makes it a little bit dangerous to be selling down here. You will have some traders saying that, believing that the channel down is tight enough that traders can sell and scale in on the first trend line break. But for me, if I'm going to look to sell, I'd rather sell a rally. I'd rather see what the rally looks like. The dominant feature of the day is the rally from the 6 low to the 36 high. And the bears have not clearly gotten a strong bear breakout. They've disappointed the bulls and gotten a strong trend line break. But most of the time, whenever you get a trend line break, usually you need a retest. In other words, typically, in order to get a major reversal, you typically need a retest of the original extreme. Bull bar 48, bad low one short, but it's also a bad stop entry buy. So the bulls are continuing to not do enough to stop the selling. But to me, I'd rather wait for a stronger downside breakout or wait for a pullback to sell. To me, you're right in that zone where bulls may start buying. The high of 23, the high of 24. Getting the downside breakout. So let's see how this bar closes. Looks like the bulls are giving up. So probably going at least a little bit lower. It's important to see how this bar closes. Traders are willing to sell, but if this bar starts to pull back and not race down quickly, you'll have more and more traders begin to take their profits. So traders want to see, is this going to be exhaustion, or is this a breakout and the start of a measured move down? We're right at 4,400, so probably some profit taking here. Right around 50%, so that's another reason for traders to start buying, at least buying back some of their shorts. Looks like that was more of an exhaustion bar than a breakout. So when you look at the close of 49, do you really want to sell it? Or do you look at that and say, yeah, I don't know. If I was a bear and I sold earlier, I would probably use that to take profits. And I think that's how a lot of traders see it. Always in bears, they probably get out 3 or 4 points above any bar at this point. The bears want to keep this measuring gap open but I suspect it's probably going to close. Just like the bulls, they had a rally and they were trailing a stop. The bears are doing the same thing. Bears, they may have sold anywhere in here, maybe 42, 43, and that might put a stop a couple of points above every bar. And so far, we have not gone high enough to stop those bears out. The bears are hopeful that 49 was a strong enough surprise, that 50, that the tail on 49 is a pullback, and that 50 will close on its low. I think more likely there's probably buyers near the 49 low rather than sellers. This whole thing is still probably forming a trading range, even though the pullback is much deeper than what the bulls want. I'm less certain we're going to get all the way up here, but I would not be surprised if we have some sort of 50% pullback from the high of 37 to these lows down here. Still, not a reason for the bulls to buy. Breakout 49, inside bar 50, low one short on bar 50. And it might lead to a pullback, but the channel down so tight, even if we trigger the sell below 50 and pull back, the upside is probably limited. Tight bear channel, first reversal up, probably will fail. So that means there's probably sellers somewhere up here rather than buyers. A lot of bulls at this point would rather see a decent trend line break and then a retest or a strong upside reversal. For the bulls, they hope it's a micro double bottom, but the sell-off is so tight that the first reversal up is probably going to be limited. And the bears, they will continue to sell. They'll continue to sell until the bulls can break the trend line. I think it's okay to wait for a few legs sideways to up. But it is important to remember 15-minute chart, series of bear bars. But the series of bear bars is following this. So while the upside is probably limited, I suspect the downside is also limited. 51 doji bar limits the amount of bulls that are willing to buy above it. Probably buyers below 51, but with the channel down being tight, the first reversal up is still probably going to fail. So even if there are buyers down here, the upside is probably limited. We may have to get closer to the moving average, but probably sideways here. There's the midpoint of the week, or excuse me, midpoint of the day. And always in short. The bears, like I said, bears, if they're trailing a stop, they're short, and they probably have a stop above 52 or 53 at this point. A stop above 52 or 53 at this point. Getting near a measured move target from the high of 42, low of 47, down here. What about buying this bar, betting on exhaustion? I would not. I think most traders should wait for more buying pressure. 53, surprise bar, probably going to go at least a little bit lower. If 54 is a big bull bar, that might be enough to entice bears to exit. It's possible we get all the way down to the 6 high. Why the 6 high? Because it was a bad buy signal bar. And traders got trapped. It was reasonable for bears to assume after this many bars down, probably sellers above or sellers around the midpoint from the high of 3, low of 6. And therefore, there might be buyers somewhere down here. I don't think we'll get down there, but if 54 is another big bear bar, we could easily vacuum down to the low of the day. It's like Al said over here when he was talking in the room. The odds were, at this point, we've seen the low of the day. Here, same thing. Odds are, 90% chance we've seen the low of the day. But as the bars get bigger and you get a big bear bar here, if 54 is another big bear bar, the probability will increase that we're going to fall below the low of the day. Strong as 54, 53 is, I think the bears need one more bar. It'd be better if the bears can get a strong follow-through bar. Right now, you can see bears are hesitating. Bears are using 53 to take partial profits. Bears trying hard to get follow-through on 54. 54, a doji, minimum follow-through for the bears. Bad buy signal bar above 54 lowers the probability of bulls buying above 54. Probably going to go at least a little bit lower, but you're getting low in the overall range of the day, and this is an area where bulls will probably buy. Some traders who sold the close of 53, disappointed with 54, they'll look to get out break even around the 53 close, but probably sellers above and a second leg down. So what about buying and scaling in lower, betting that we've seen the low of the day? It'll probably work, but my concern is open gaps. Open gap, 47, 48 low, 50 high, big breakout here, and a possible another open gap. And we're always in short. In general, when the channel's tight, it's really better to wait for stop entries. And if the channel's really tight like this, it's better to wait for a trend line break and then a retest. Here, the market's forming a series of wedges, but look at a 15-minute chart. Where's the wedge? There is no wedge, and there's no wedge because this right here is a breakout on a higher time frame. You can call these parabolic wedges or minor wedges. Minor wedges lead to minor pullbacks, and if the wedge is really tight, it can often lead to a pullback lasting a few bars and then lower prices. We're spending a lot of time near the 53 low. What about buying below 55, betting it's a bad low one? Probably buyers below 55, but the buyers might be there for a scalp. The problem buying here is the channel down is fairly tight. That's the risk that the bulls face. You have to ask yourself, why are the bulls not able to get a reversal here? The bulls have a micro channel ever since right here. So that's a warning that the market is a little bit extended. Low one short, probably buyers below, but with the channel down being as tight as it is, that will limit the amount of bulls buying below 55. Some bears are just staying short and they're trailing a stop, and they'll exit a couple, maybe 3 or 4 points above the 55 high. They're hoping that we get a downside breakout below 55, trapping the bulls who bought the low one. I think it's reasonable for the bears to exit above any bull bar at this point. Tight channel, but it's climactic and it's in the bottom third of the day. Probably going to oscillate around the midpoint of the day, this blue line. I think it's okay for always in bears to exit above 56 and wait for a couple of legs. Probably going to go mostly sideways. Bulls trying to get a strong entry bar. The bigger this bar gets, the more bears will exit. We'll probably try and test the high of 53, but the bulls need a strong entry bar. They have a decent signal bar, 56. They need 57 to be a strong entry bar. And they'll want a test of the 53 high and the moving average. Disappointing entry bar, 57, but a bad low 1 or low 2 short below 57. Probably going to go at least a little bit higher. And probably going to try and test near the 53 high and the moving average. The bulls are hopeful this will lead to a bull breakout of a bear flag. So we have the low of 54, high of 57. The bulls want an upside breakout and a test of 4,400. And I think that's where we're going. But let's see. Low 2 short, 58, but a big bar, so big risk, and we couldn't trigger it. So now the bulls, they want a bull breakout above this bear flag, and they might get it. Inside bar, 59, but a tail above 59. Okay, swing buy, but tight bear channel. Some bulls will buy above it, and they'll be really quick to get out. I think it's better to see what the breakout looks like. The bears, they hope this forms a wedge. 1, 2, 3. But a micro channel since 56, and probably going to test near the 53 high. Most traders be better off just waiting for, if they're looking to buy, wait for a clear upside breakout. Probably going to go sideways here. But I suspect buyers below 60, buyers below 59, and a trading range. Another failed stop entry below 60, and you can see 61 buyers below. The bulls are trying to get the upside breakout, but until there's a breakout, there is no breakout. Probably going to go sideways here and get closer to the moving average. $62 bull bar closing on its high. I think always in bears, if they're still short, I think it's reasonable to get out above 62. Too much risk at 63 is another bull bar. Testing the high of 53, getting close to it, and the moving average. The bears are hopeful that 63 is a bear bar closing on its low. But we're getting a lot of bull bars in here, and that will increase the probability of some kind of measured move up. No surprise, a measured move from the low of 54 to the high of 58 takes you up to the low of 48 and 47. That is an obvious breakout point. 63, bad sell signal bar for the bears, or weak sell signal bar for the bears. They hope it's a wedge. 1, 2, 3. And the bears hope that 64 is a strong entry bar, but probably buyers below. Because it's a possible wedge, there's added risk for the bulls buying below 63. So 64 is an important bar. Will the bears get a strong bear bar closing on its low? Or will the market form a weak bear bar? Bulls tried to get an upside breakout with 64, and they could not get a close above the moving average, so traders sold it. Are we always in long? I don't think so. I think the bulls need to do more here. And because of that, that increases the risk that this is a bear flag and we pull back and start to go sideways. Until the bulls get a clear breakout, it's best to assume, ideally, unless the bulls start to get 2 or 3 closes above the moving average, like here, the bears, they got 2 or 3 closes below the moving average, it's best to assume that the bulls are going to fail and that we're going to continue sideways. So this is kind of what I was talking about. The bulls needed just a little bit more, and whenever the bulls don't get that little bit more that you think they need, this can always happen. And I like to think about it as, really, let me just reiterate what Al says a lot in the course. Al always talks about how you typically, it's very common for bear trends, whenever you get a pullback in a bear trend, the pullback looks a little bit extreme, and you start to question if the market is always in long. However, so you start to look at this bar and you think, yeah, market's, I think it's always in long, but I don't know. I think the bulls probably need one more big bull bar to seal the deal. And instead, the bears get a bear bar. And then you say, well, wait a minute, that doesn't look right. The bears were supposed to get another bear bar, and they couldn't get it. And because of that, a lot of traders start to, if they were long, they start to sell out of their longs, betting that the market is going to do something disappointing. And there is the disappointment. And the bulls even tried one more time on 64, and they gave up. Bulls, they see a failed breakout below the lows of 54, and they want a reversal up. 66 so far, good bar for the bulls. If 66 closes on its high, I suspect a lot of bears will look to exit. Because of 65 is a big enough bar that we may get a small second leg down. So unless 66 is a strong bull bar with a small tail above, I suspect there will not be that many bulls buying above it. In other words, I suspect we'll hesitate. If the bar closes like this with a little bit of a tail, we'll probably trigger the buy, but we may go mostly sideways. Let's try to put on a 1-minute chart. Some traders, they sold the close, and they're disappointed by the pullback, which is this bull bar right here. What do you think those bears are going to do down here? They sell, they scale in, they're going to look to get out, break even. So we may test near the close of this bar or near down here and bounce. But this is good for the bulls. But I don't think it's enough. So it'll be interesting to see what the bulls that sold the 66 close will do. How disappointed, it'll be interesting to see the bears that sold the 65 close. What will they do here? You can see a lot of traders who bought the 65 close, or they bought up here and scaled in. They used the rally to sell out of longs. So how desperate will the bears who sold the close of 65 be to get out of the trade? Some traders who sold the 65 close, they'll be disappointed by the rally, and they'll have limit orders down here to go ahead and buy back shorts, betting that this bar will disappoint traders. Bears are trying hard to get followed through. But if 65 is such a strong bear bar, why is the follow through? Why are we 3 or 4 minutes into the bar and going mostly sideways? And the reason for that is the bears are not as strong as they could be. If the bears were really strong and really desperate to get short, we would not be doing this. Big bear bar, immediate follow through. Now this was a vacuum, but if this bar was really strong and very bearish, we'd be racing down. It's possible the bears are waiting to see the follow through bar. So if 66 is a bad stop entry buy, you may have a lot of traders sell the market betting on a second leg down after the 66 close. And I think I said 65. What I meant by that is a lot of bears, instead of selling the close of 65, they'll wait and see the follow through on 66. And if 66 is a bad stop entry buy, you may have bears sell the market. So let's see what happens in the next 30 seconds. So a disappointing bar for the follow through for the bears. That will limit the downside. Always in short, but I suspect there's buyers probably not that far below. You can see 66, look to the left, it's testing the midpoint of bar 9. Midpoint of bar 9. so probably going to start to go sideways soon. What about buying the close at 66, putting a stop below 66, front running the buy above? I would not. With the big tail above 66, that will limit the upside. You can see bears not desperately buying back shorts at the 65 close. The bears are not selling aggressively either. Traders are waiting to see what the follow-through looks like. Will 67 be a big bear bar closing on its low? Will it close below 66? Or will it look like this right here and be a bar closing at the close of 65? Disappointment bar for the bears and the bulls. Probably sellers above 67 and at least a little bit lower, but not all that great a follow through. What about getting down to the 7 high? We might, but the bears, they have a low 1 short and there's probably buyers below. But if the bears get 68 to close on its low, 69 to close on its low, we could race down pretty quick. I suspect with the rally up to 64, there's probably buyers below. Bears giving up, so probably going to test the 64 high. This bar is important. Will the bulls buy into the close of the bar, or will we get a tail on the close of this current bar? Tail on 68, so a sign of hesitation, but 68 is enough of a surprise. Probably going to go at least a little bit higher, and at a minimum, I think we're probably going to test the 64 high. So the bulls, they want a lower low major trend reversal, bear trend line break to a lower low, and an overall higher low with the rally from earlier today. So let's see what the bulls can do here. Will 69 be another big bull bar? Will it close above the moving average? Will it close above 65, or even possibly, but less likely, close above 64? And right now, you can see it's disappointing. I realized I was on mute, but some of the bulls who bought the 64 low or the 64 close scaled in lower, and they're selling out alongs here. I still think 68 is strong enough for a second leg, and even if 69 is a small bull bar or even a small bear bar, probably buyers below for at least a brief second leg up. 69 close under the 68 high weakens the probability for the bulls, but 69 is at least a bull bar, and it's a bad low 1 short for the bears. So probably buyers below. And because it's an obvious bad low 1 short below 69, you may have more traders just buying the close at 69, betting on a brief second leg up. 4,400, big round number, just above. And we may try and close right around it. Also, the midpoint of the week is a magnet, and we're a little bit above it. The bulls are trying to get another bull bar, and the bulls are going to try, let me back up. The bulls want to get a bull close above the 69 high. That would increase the probability of higher prices. They need to break above the moving average, though. Just like the bulls failed around 63 and 64, the bears are hoping that the bulls will fail again around 69 and 70. We triggered the sell below 69, probably buyers below though. Another bull bar, probably going to test the 64 high at a minimum. What are the chances we get a buy the close rally and we break above 4,400? We might, but the bulls need to grow. They need to show more signs of strength. Ideally, they need to close above 64. Next, they need a strong close above 64. And it'd be better if the bulls can get a strong bull bar, something like bar 8 and then 9. And you know they're probably not going to get that. Some profit taking back at the 64 close. Close of 64 is 97 even. The high of this bar is 97 even. So I think we're going to get to the 64 high. By the way, here in a couple of minutes, I'm going to review the questions and start answering them. So there doesn't appear, I'm looking at the questions in the GoToWebinar, and there doesn't look like there's too many. So if anyone else has other questions, I should be able to answer all of them. And I'm probably going to start talking about the questions here in about the next 10 minutes. So the bulls are trying to get an upside breakout, but you can see it's still a trading range. The bulls are hopeful they get an upside breakout, but they know the reality is they're probably not going to get the upside breakout. We're probably just going to stall somewhere around here. And traders are wondering about the bears who sold the 66 high, the 67 high, somewhere in here. Traders know those bears are probably going to make money. So 71, a bear bar, but a weak bear bar, probably buyers below, and probably buyers below 72. But top of the trading range, the pullback could be all the way down to the 67 high. Okay, so I'm reviewing questions now. First question. Is it okay to borrow profit targets from higher time frames? I know it's recommended to trade only one chart, but when there's a micro channel on a 5-minute chart, I know it's a spike on a 15-minute chart. Yeah, so what they're saying is if you have a tight bull channel, like right here, you know it's the breakout on a higher time frame. I agree with that. Okay, next piece of the question. Or if there's a wedge on a 5-minute, but also on the 15-minute, then 10 bars, 2 legs is expected on the highest time frame of that pattern, right? Yeah, so that's kind of a long question, but let's talk about basically what they're asking. What they're asking is if you get say you get a breakout like this, you know on a higher time frame it might lead to a measured move up. Or an easier example is, let's take, well, the first thing, let me just start over because there's a lot of little things to the question. And if I'm understanding the question correctly, what this person's asking is, can you look at higher time frames to get a better idea of profit targets? And that makes sense. If you were aware of, let's say, and that's kind of context really. If you have the daily chart, the day gaps down, and it was reasonable to assume we had a high one buy yesterday, probably sellers above, we gapped down. It's reasonable to assume on the open there's probably going to be buyers. So it's reasonable to assume you'll get a rally. And there's certain instances, let's see if I can find a better example. You know, kind of like this, we had this really big bear breakout. You know, it's a breakout on a higher time frame, and therefore on a 15-minute chart, this is just a series of a few bars, and you're probably going to get a couple of legs down. You know, I know I'm not answering the question as well as I could. And let me fix this chart. I don't know why it's doing that. But overall, I would stick with one time frame. You know, it's okay to understand context. And what can be helpful with higher time frames is when you see this, getting a better understanding that this right here, bars 27 to 45, looks like this right here. So it's a breakout on a higher time frame, and the first reversal up is probably going to fail. Okay, next question On bar 10, Al said to take partial profits right here, and said he expected the gap above the 3 close right here. Oh, the gap above 3 to close. Why is this? Why was this his opinion at this point in time, given the surprise 8 and 9? Yeah, it's a good question. So why? We have a big breakout, 8 and 9, and Al says traders should take partial profits because we could sell off and test this breakout point. Why? The answer is because most of the time, the market does disappointing things. In other words, most breakouts are within a trading range, kind of like the daily chart. We had a breakout on, let me fix something. We had a breakout right here over the past week or so. Right here, bull breakout, follow through, and it's a strong breakout, but it's because it's in a trading range, we could easily get a very deep pullback, and then the range gets extended. The breakout does. In a trading range, you get deep pullbacks. General rule of thumb, most breakouts are within a trading range and they lead to a deep pullback. And even if the move starts to go higher, you can always add to your position. So what I was trying to say was, if you're buying here, have enough ammunition, if you will, or trade small enough so that you can buy more down here if you're long. But a good rule of thumb is most breakout points close, especially in a trading range. Okay, question. Yesterday, Rose mentioned Al's past daily videos from 2018 to 2019 are available for sale. Where do you find them? Yeah, so where do you find the trading room? The trading room, where do you find the old trading room videos? If you go to the brookspriceaction.com website, and I think you can click on, it's under forms, but if you just look around and make sure you're logged in, you will be able to find them. You can purchase a year's worth of videos. You can purchase a month. I think for a year, I want to say it's like $200. And for a single month, I think it's like $50. But I believe you can go back as far as you want. Okay, question. Al keeps talking about outside up. What does this mean? Are we going to have a failed breakout, then evolve into a trading range? Outside up means we're going to break below yesterday's range or yesterday's low. It's easier to explain on the daily chart. This is outside up. We went below yesterday, this bar, and then we went above yesterday. So that is an outside up pattern. Okay, question. Using a binary decision tree, 37 would not be a sell because of a tight bull channel. Let's find 37. So using a binary decision tree, 37 here would not be a sell because of a tight bull channel. However, let me first say a few things. I thought selling below 37 was going to lead to a minor reversal. I didn't think this was going to happen. I thought we would get a sell off to the moving average and then a retest and then a second leg down. But sometimes this happens. So back to your question. However, selling below here with 2 times risk and 40% probability should be an acceptable trade. How do we balance binary decision trees with traders' equations? Well, you did the right thing. In general, if you're unsure, always just assume the probability is 40%. And when you get a reasonable sell, here you have a lot, it's consecutive buy climaxes, 1, 2, 3, 4. We have a wedge, 1, 2, 3. And think about it from the perspective of the bulls. If you're long, where are you going to get out? If you're long from here or here, there's really no reason to get out anywhere in here. And then you get this big bear bar, 37. 37 is a strong enough bar. You're probably going to get a small second leg down. And because of that, if you're going to get a small second leg down, it makes a lot of sense to exit betting that you can enter lower. So bulls, they sell below 37 to take their profits and exit the trade. Bears will sell betting that they can at least hold for at least a few bars or 1 or 2 legs and a test of the moving average. So that's why traders get out there. A good rule of thumb is 40% of the time you're going to catch a big swing. You buy above a bar like 6. 40% of the time you're going to get an upside breakout. 60% of the time you're going to make a little money, lose a little money. And obviously context matters. We had yesterday's high right here, this blue line, and the market broke above it. The odds were, because of the range of the day, and we went below yesterday's range and above it, the odds were we were going to get back to yesterday's high. And when you get this big bear bar here, you know it's reasonable for the bears to exit, for the bulls to exit their longs. I'm always thinking about, that's why I say it's so important to understand swing trading. If you can understand where the bulls have to get out, where the bears have to get in, or where the bulls have to get out, where the bears have to get out, it'll help you understand where reasonable entries are. But I agree with you. This was a minor reversal, and we ended up getting an endless pullback and a sell-off to the bottom of the channel, and sometimes that happens. You can see we finally got above the 64 high. We had a leg one, pullback, leg two. By the way, one of the things, speaking of leg twos, a good rule of thumb is whenever the market's in the trading range, it's really important whenever you see a second leg up. In this case, it's a little bit different. Let me find a better example here. Let me find what I'm looking for. Maybe right here. Whenever you get a second leg down and you know the market's probably in a trading range, so we rallied, we pulled back to bar 23, and then so leg one, pull back, leg two. Whenever you get a leg one, leg two, in general, it's better to assume that if you know the market's in a trading range and you think you're relatively low in the range, if you're short and you get a bull bar closing near its high or above its midpoint, it's reasonable to just take your profits or exit the trade. So right here, leg one, pullback, leg two, at resistance, 4,400. If this is 78, obviously this is late in the day, so I would not scale in. But in general, if 78 is a big bear bar closing on its low, I would not scale in below the bar. I would just exit because there's too much risk of a downside breakout. A little bit different here because we've broken out above bars to the left. But in general, leg one, whenever you have a breakout, that's a part of leg one, you can scale in betting on a second leg. Whenever you get a leg two, and it's within a trading range and you're near resistance, if it's a bull leg, it's really dangerous to scale in. And that's the same for the opposite for the bears. Okay, back to questions. Question, if always in bulls exit below 37, is that enough reason for always in bears to short? I know it's not a V top, so let's look at that bar real quick. So let me repeat the question. If always in bulls exit below 37 here, is that enough reason for always in bears to short? I know it's not a V top, but I was looking for a retest and a major trend reversal, and it never came, and I don't know how or where to get short. That's a great question. Whenever you have an area, whenever you look at something and you think, wow, always in bulls should probably get out there, you instantly know that always in bears can sell there. That does not mean the market is clearly always in short. It's kind of like you're fishing. The bears are selling below 37 and they're trying to catch, they're trying to, for lack of words, set their trap or set the hook and trap the bulls. But in general, let's keep it really simple. If you look at something, like let's take something obvious, bar 8. When you see a bar like bar 8 and you look to yourself and you think, there's no way I'm going to be short on the close of bar 8, you instantly know you can buy. Here, bar 45, probably buyers below, but a retest of these highs might be a double top and a trap for the bulls. If you see a bar like 46 and you think to yourself, wow, I really don't want to be long if I bought below 45, now on 46, then you know you can be short and traders will reverse. So why do traders sell below this bar, bar 37? Think about it on a 1-minute chart. On a 1-minute chart, just kind of eyeballing it and guessing it's around, so it's around 11:35. Here it is. On a 1-minute chart, this is that bar. So the close of this bar is 35. 1135. And there's the close right here. So we went from here to here. That's trapping a lot of traders. And a lot of traders, because this bar is so big, the reason why a lot of traders will exit is because the bulls know the first reversal up is going to fail. So even if the next bar is a bull bar, there's probably sellers above the bar. It's a bad high one. And that will lead to lower prices. Let me go back to questions. But to answer your question, or to make sure I am answering your questions, whenever you look at something and you say, yeah, that's really clear that always in bulls exit below 37, you know there will be bears that go short. Now, how do you get short? It looks like a leg in a trading range. And something happened here. You got a bear breakout, follow through. And the bulls, they keep looking for a place to buy, but they don't get their place to buy. They keep looking to buy, and then they get a bull bar, but the channel's tight. Some bears, they'll look at 37 to 44 and they'll say, yeah, it's a second entry. It's probably the bottom of the trading range. But when I look at a 15-minute chart, the channel down is really tight, and this is a breakout on a higher time frame. So here is somewhere around here, and the first reversal up's probably going to fail. And because of that, bears know the bulls need a strong upside breakout and a retest. They need a mini major trend reversal for this right here, and they never get it. So some traders, they'll trail a stop. They might put a stop 2, 3, 4 points above any bar, and they'll just hold, and they'll keep moving their stop. And look what happened. They never got stopped out. And then at some point, maybe they got out here, and some traders would sell again right here. But you see my point. They just got in. These bars, 44, 46, 48, can be deceiving. It makes you think that the market is going to reverse, but it's a tight bear channel, and tight bear channels are not ideal places to buy. Okay, let me go back to questions. Okay, question. From bars 37 to 54, from here to here, is bar 39 here a good sell signal bar? Yeah, it's reasonable. 3 consecutive bear bars. First reversal up will probably fail. Probably going to test the moving average. I think that's okay. I thought it was part of a trading range from bars 30 here to 40. So they thought this was a trading range, 30 low to the 37 high. Yeah, I thought that was reasonable. How about bar 42? Is it okay to sell the close of 42? Breakout of the bottom of this trading range right here, probably going to go lower. Yeah, so what they're asking is 42 a reasonable sell? 42, to me, I thought the market was trying to bottom. But the one thing you always have to think is when you see a bar like 42 and you look at 12 o'clock and you notice that the bulls are not making money above bars, and you notice that the bulls who bought up here, they're getting squeezed. I'm always looking at the moving average. And remember what I said right here? I thought, okay, we have a close below the moving average. That's good. But if 43 is another big bull bar, we could reverse up to the 36 low. And instead, 43 is a bear bar. So now we have 2 closes below the moving average. And whenever you have a lot of bars above the moving average, once you start to get 2, 3 closes below the moving average, especially if their bar is closing on their lows, that will increase the probability that the market is going to go lower. So 2 consecutive bear bars, even another bear bar, even with the bar like 44, as good as it looks, do you really want to sell? Do you really want to buy the close of this bar? Probably not. You can, but if you buy the close of the bar, the best you're going to get is a rally maybe to the prior bar, which is 15 even. So even if you buy here, the best you can expect is a rally somewhere up to here. So the probability is not that great. The channel down's tight. A lot of traders, instead of buying, they'll wait for a strong upside breakout and a retest. And in this case, the bulls tried numerous times. But what do you notice here? The bulls are failing. The bears are getting a lot of bars below the moving average. And then eventually, the market crept down to the low of the channel, the 12 low. And then obviously it broke below it here. Okay, let me look for one or two more questions. Okay, question, can you please explain why price bounced at the midpoint of bar 9? I'm assuming you mean the midpoint. I'm assuming you mean during 66. Yeah, so why did 66 bounce? Well, if you're a bear, you had some bears selling above bar 8. And their premise was it's a two-legged pullback, it's going to be a trap. Maybe it's testing the moving average, but this is going to be a trading range. And those traders, they got trapped on 9. A lot of those bears would just take the loss and move on with the day. However, whether or not they sold out, what do you think the bears are thinking here when the market gets all the way back down here? The market has memory. So if this was a bad area to sell during bar 8 and 9, you know it's probably a bad area to sell again later on in the day. The bulls will look at it and say, wow, the market really went up. It went up really quickly during 8 and 9. Maybe it'll do the same thing during 66. And that's what happened right here. And there's also other reasons. One was you had traders who, some bears sold and scaled in all the way up, and they're taking profits on the way down. You had other traders. Other traders will look at big bars and try to buy the midpoint. They'll try and buy retest of the bars. Okay, question. Would it have been reasonable to buy the close of bar 36 here and buy more above a bar like 41 here? Would it be reasonable to buy even more above 44 here? If so, at what point would it be a good idea to stop out and not buy anymore? Yeah, so that's a good question. If you buy the close of 36 and then you buy more here and then you buy more here, what do? One of the problems with this right here is there's a few things. One, I thought we were going to test the moving average. And then number two is most traders, if I'm long and if I buy the close and I buy more lower, I'm always going to get out if my premise changes. An easy way to think through that is I'm going to get out if the always in direction changes. So if you buy and then you start to get bear bars closing on their lows, you're better off just getting out and moving on with the trade. Or if I'm long and I get 3 consecutive bear bars, I'm going to get out. Ideally, if I'm long here and then I see a big bar like 37, I'm going to get out. The only problem here is when you look at these bars, sometimes it can be helpful to look at a 15-minute chart. And remember what I said, 3 consecutive bear bars. This was at 12:15. Here is 12:15. When you look at this, if you bought the high close of the day right here, and now you have 3 big bear bars, do you really want to stay long? Of course not. There's too much risk of a second leg down. And that's why I was saying in here, the bulls, they're trying to stop the breakout, but they really need an upside breakout and then a retest. They need a trend line break of this sell-off and then a retest of the lows. So in the daily chart, we have a tight trading range here. We formed an upside breakout, but the one thing I've been saying on the daily chart is as strong as the bulls were here, we're in a trading range. And whenever you're in a trading range, you always have to think about deep pullbacks. You see big bull bars, but this is sort of similar to the problem here is the market never became clearly always in long. And if it's not clearly always in long, a lot of traders, when they think the market is becoming always in long, they'll start to sell. They'll start to take profits betting on a deep pullback, and that's what happened right here. So what do I think is going to happen? Well, we have a very tight trading range, and the market's deciding, are we going to go up or are we going to go down? If you remember at the beginning of today when I started talking, today was closing on its high, I said that this might be the day where the bulls try and start the second leg up. So leg 1, pullback, leg 2. But I also mentioned that the bulls needed today to close on its high, and they really needed follow through, and obviously they didn't get it here. So to me, I think we're in a trading range, and we're going to be probably sellers above, buyers below for a couple of days. First bar of the day, we gapped down, and we broke below yesterday's low, the low of bar 1 yesterday. And we formed a bull bar closing on a tie. It's an okay swing buy, but as you know, 20% chance that bar 1 is the low of the day. And that means 80% chance that this is going to form a tight trading range. Bar 2 is a doji. The market sold off on 2 and rallied, so it's a small trend line break on a higher time frame. What about always? Is the market always in long? In general, for always in long, you want one bar closing on its high, and then you at least want another bar closing above its midpoint. And we have that, and we might be always in long. My concern is the size of the gap down. We're below resistance, yesterday's low. Okay to be long, but I think that we're probably going to go mostly sideways. Bar 3, bear bar, but a tail below the bar increases the risk that there's buyers below and the market's going to go sideways to up. Bar 4, another tail. So what happened on the close of bar 4? Well, look at the close of bar 2. The market rallied to the close of bar 2 and it sold off. So the bulls who bought the close of 2, disappointed with 3. They were disappointed that 3 sold off. What did they do back at the close of 2? Those traders ended up selling out of their longs and the market sold off. As far as selling the close of 4, you can, but you're selling at the bottom of a trading range. And then bar 5, we have a bear breakout below 1. 3 consecutive bear bars, but bar 5 closing near the low of the bar, but we have a tail on 3, tail on 4, and it's a possible failed breakout below 1. So as strong as bar 5 is, it's better to wait for follow through. It might be always in long, but the bears really probably need one more bar. If bar 6 looks like bar 5, it's probably sell to close and going lower. Bar 6 is a doji. What about selling the close of 6? I would not. It's a possible failed breakout of the 1 low. And because of that, and it's a possible second failed breakout below yesterday's range, and we could easily rally back above yesterday's low, this blue line. 7, bad, low 1 short, so probably buyers below. Sometimes when you get a low 1 like 7, and it's obviously a bad low 1, meaning it's a bull bar, there's a big tail below the bar, and the context is bad. It was sell to close on 5, disappointment on 6, and those traders are getting out. So the bears that sold to close of 5, disappointed with 6, they use 7 to buy back their shorts. That reduces the number of traders willing to sell below the 7 low. And that's why 8 looks the way it did. 8, strong bull bar. I believe it's also no, it's not the report bar. 8, strong bull bar. Always in long, closing far above yesterday's low. Probably going to go at least a little bit higher, so probably buy the close. And then 9, follows through, so still buy the close, going higher. Reasonable to assume you're going to get a measured move up in a test of yesterday's 81. Yesterday's close, which is bar 81. And then 10, we have a weak bull bar, and you can see tail on 9, tail on 10, 10 failed to close above 9. All of that is a sign that the market may pull back. And if it does pull back, we could test near the 3 high, which is what Al said. 11 is an outside up bar. We broke below 10 and reversed up. And you can see a lot of traders that bought below 10, they scalped out as the market went higher. 12, inside bar, bear bar, but probably buyers below. There's a big tail below 12. That lowers the probability of the bears selling below 12. And you can see there were buyers below 12. 13, inside bar. You can call it an inside bar. Excuse me, it's not an inside bar. Failed breakout below 12. Bull bar closing on its high. For the bulls, it's a high 1 buy. There might be sellers above, but the breakout 8 and 9 is strong enough that even if there are sellers above, the best the bears can hope for is a small scalp. So that means there will be bulls buying above 13 and buying more around the midpoint of 13 or the low of 13. And then 14, surprise bull bar, but a tail on the close of 14 lowers the probability of traders selling, lowers the probability of bulls buying the close of 13. However, because of the bears who sold the high of 12, sold the high of 11, or sold the high of 13, anywhere in here, you know those bears are trapped, and they'll use any reversal down to buy. So bulls will buy and buy pullbacks, and that's what happened on 15. 15, a bear bar, but for the reasons I just mentioned, bears that sold in here and scaled on higher, they're trapped. They'll probably use 15 to buy back their shorts. And that's what happened on 16. 16, doji, outside bar. Outside bars are usually trading range bars, and that will lower the probability of traders buying. That will lower the probability of traders selling below 15 or buying above 15. Let me back up. That will lower the probability of traders buying above or selling below bar 16. You can see the traders that ended up buying the close of 14, they were disappointed with 15, and they used 16 to sell out of their longs at the high close. Let me adjust the monitor really quick. 17, bear bar, closing on its low. Probably buyers below, but because you're in the middle of an overall trading range and you're starting to get overlapping bars, we could easily break to the downside. 18 failed to break below 17, and instead bulls bought the close. Why did bulls buy the close of 17 during 18? Because they saw it as a two-legged pullback. We have a bear bar on 15, we have a pause on 16, and another leg down on 17. And then 19, we have a bull inside bar. For the bulls, low probability, buy above, probably sellers above, but it's an inside bar, and we have targets above, a measured move from the open of 8, close of 9, so probably going to get it somewhere up here. And then 20, we triggered the buy above 19 in reverse down. You can see traders, they saw the selling up here, and some of the bulls who bought above 19 as the market went higher and tested 4,000, this blue line, a lot of traders started selling and they started taking the profits. Some traders, if they take a low probability trade, they'll pay really close attention to how fast the bar goes up. So let's look at that. The open of this bar is 10 o'clock to 10:05. So let's go to a 1-minute chart. I just want to see how the bar formed. You look at this bar. Well, actually, the open is 10:05 to 10:10. We look at this bar and we see it's a bear bar, but it's important to pay attention to how fast the bar reversed. So there is 10:06. So in one bar, this bar shot up and pulled back. So in the first minute, it shot up and it started to stall. And if we look at the high of this bar, the high of this bar is 95.75. So the bulls that bought above it at 96 even, they needed the market to go to 97 and 98 and a quarter to make a 1-point scalp. And look right here, the market went to 98 and a quarter. So the bulls who bought above 19 scalped out for 2 points. It immediately raced up for 2 points and then reversed down. 21, a bull bar. Instead of bears selling the 20 close, bulls bought it. Why did bulls buy the 20 close? Because they wanted to prevent the bar from triggering. They saw 20 as a possible truncated wedge, 11, 14, and 20. And because of that, you had traders front running there's two things. One, there was bears front running the 20 close, trying to make it trigger. And you had bulls buying the 20 close, putting a stop 1 tick below 20. So they buy the 20 close. As soon as this bar closes, they hit buy the market and they put a stop 1 tick below. And they're buying aggressively. They know it's a low probability trade, but they're trying to trap the bears, and that's why this bar reversed up. And now 21 is a big bull bar. It's trapping the bears who front ran the 20 close. Instead of some bears sold the close of this bar anticipating that 20 would trigger, and it didn't. It's not a great sell because it's right at the moving average. 21, okay, swing buy, triangle, targets above. And then 22 broke out to the upside, testing near the target. The open of 8, close of 9, the target is 4.5, and you can see the high of this bar is 375, so still not quite to the target, may go a little bit higher. 21 and 22 is enough of a surprise, probably at least a small second leg. 23 is a bear bar. So 23, bear bar, you can see traders taking profits right at this measured move target. What about buying? What about selling below 23? I would not. It's okay to buy back, to sell out of longs below 23, but with the tail below 23, and it following 21 and 22, the odds are the bulls will get at least a small second leg up. 24, inside bar, high one buy. There might be sellers above, but because of 21 and 22, it's reasonable to assume that we're going to get at least a brief second leg. You can see the bulls that bought the 22 close disappointed with 23. They used the rally on 24 to sell out of longs. And then 25 is a little bit of a surprise. What happened on 25? The bears who sold the 24 high or the 23 high are trapped. And some of those bears might be quick to sell out of their longs. Some of those bears who are short on 24 or 23 will be quick to buy back their shorts at the 24 or 23 high. And instead we got follow through. So we're getting follow through buying, and you're going to have bears more eager to exit. We're so close to yesterday's high, we'll probably get there. So it might be buy the close. 3 consecutive bull bars, first reversal down, probably will fail. There we go. 27, bull bar, closing on its high. Okay, buy, betting we're going to get to yesterday's high. 28, another bull bar. What about buying the close 28? Some bulls might, but they'll probably, I suspect they'll be quick to get out if the market starts to stall. We're right at yesterday's high, and the odds are we're probably not going to go all that much higher. 29, bear bar, but a tail, probably buyers below and a brief second leg up likely, so the bulls who bought the 28 close and more lower probably will make money. 30, a doji, probably sellers above, and at least a brief, let me back up, 30, there might be buyers above briefly, but I suspect they'll probably scalp out, which means there's sellers somewhere above 30, maybe a measured move up of 30, so it might be sellers around 44.18, and that's what happened on 31. 31, disappointment bar for the bulls increases the probability that we're going to pull back, but if we're going to pull back and get to the moving average, the bulls need to do more. And because of that, we're probably going to go sideways and try and form a top. 32, inside bar, probably sellers above. 33, a doji, which you can see, body is weaker, and we could not close above 32, so that's a sign of weakness for the bulls. What about selling below 33? I would not. It's a tight bull channel, 4-bar micro. Here's my internet went out for just a moment, but it looks like the audio is working. So anyways, what I was saying is there's probably buyers not far below, but I think we will get to the moving average. 34, inside bar, but still probably buyers below. Until the bears get a strong bear breakout, it's a small pullback trend, and it's better to only look to buy. But it is okay to sell out of longs below any bear bar closing near its low. Other traders, instead of exiting below 29 or 34, they'll put a stop 3 or 4 points below any bar, taking a chance that will continue higher. 35, outside up bar, trading range bar. Not ideal to buy the close, probably sellers above. In general, trading range bars are outside. In general, outside bars are typically trading range bars. 36, bull bar, closing on its high, but probably exhaustion. And then 37, big bear bar, reasonable for bulls to exit below 37 and wait for a couple of legs sideways to down. 38, a bear bar, closing above its midpoint, but it's a weak high one buy, so probably sellers above, and then it didn't trigger. 39, bear bar, closing on its low, but closed above the 38 low, a sign of weakness by the bears. But with 3 consecutive bear bars, it might be sell to close, betting that we test near the moving average. And then 40, a surprise bar, but a big tail. Probably sellers above. What about selling the close of 40? Some traders might, but with the tail below 40, we may go more sideways than straight down. But tight enough channel will probably form a lower high and not get above 37. 41, bull bar, went 1 tick above 40, so we triggered the buy above 40, but it's a bad buy signal bar above 40, so there's probably sellers above, and then 42, we reverse down. 42, a little bit of a surprise, and because of the higher time frames, this channel down is pretty tight, which means it's a breakout on a higher time frame. What about selling the close of 42? I would not. I'd wait to see the follow through. Too much risk that 43 is a big bull bar and it reverses. But because the channel down is tight, a lot of bulls might hesitate to sell to buy here. 43, bear bar, inside bar, low one short, but tight bear channel. And because of that, we may go a little bit lower. 44, bull bar, bulls bought the low one, but what did they do here? You had a lot of bulls, they look at 42 and they say, yeah, that's a buy the close bar. It's a weak bear bar late in a trading range, so it's probably a better buy. So they buy the close of 42. And then they see 43 and they say, dang, that's disappointing. That's the opposite of what I wanted to see. So they buy the close of 42 at 15.5 and look at the high of 44. Something's not right here. There we go. They buy the close of 42 at 10 even and then look at the high of 44, 10 even. So the bulls buy this close, disappointed with 43. They scaled in lower and everyone tried to get out at the close of 42. And that's exactly why 45 sold off. And that's the problem with this tight channel. 45 bear bar closing on its low, extending the channel. At this point, we have 3 bear bars closing below the moving average. And we have 1 bar closing completely below the moving average. That's a sign of strength by the bears and increases the probability that we'll go a little bit lower. I still think that the market is probably going to bounce, but so far, this is a pretty good trendline break. 46 bull bar. What about exiting shorts above 46? It's probably okay, but you will have some traders, just like the bulls put a stop 3 or 4 points below any bar here. You'll have some traders putting a stop 3 or 4 points above any bar here, taking a chance that the small pullback trend continues. Small pullback bear trend continues. And when I say bear trend, I really just mean the small pullback sell-off. It could last much longer. 47, outside down. What about buying the close of 47? I would not. This channel is really tight, and you have open gaps, low of 36, high of 42. Fees right here, and then you have possible gap, 46 low, and right here. 48, weak bull bar, so probably sellers above, and then obviously more traders giving up. 49, close above the midpoint of the bar. What about buying the close, betting that the market's going to reverse up? You can, but because of how tight this bear channel is, it's really just a pullback. So the low, from the low of 49 to the close of 49 is a pullback, and you might have more traders selling the close of 49 than buying. 50, inside bar, probably buyers below, but it might be like 43. Bulls might buy below it for a scalp around the midpoint of the bar. So some bulls might buy the low of 51 here, below 50, and scalp out around the midpoint. 51, doji, buyers below 50 and scalped out near the midpoint, getting near the midpoint of the day. Someone asked me what this is. I just took a measured move retracement from here to here, and then I just deleted this line and just locked it in place. So the midpoint of the day is not an indicator, it's just a line that I drew. 51, probably sellers above, tight bear channel, first reversal up probably will fail. 52, another bear bar, tight channel, probably going to try and reverse soon, but this is a breakout on a higher time frame. Sometimes it's helpful whenever you see this price action, just to flip to like a 10-minute chart and just glance at it. And then you look at this and you say, wow, that's a pretty strong breakout. Maybe I should avoid selling the close. Maybe I should avoid looking to buy here. So tight channel, only look to sell. And then 53, surprise bar, probably going at least a little bit lower, but it's climactic. You can see 10-minute chart, small overlapping bars, and then a big bar. That will increase the chances of traders taking profits. It doesn't mean reversal. It just means that it's not a symmetrical sell-off. An easy way to think about it is you have a bear trend here, and you're breaking below it. So let me see if I can pull up this chart really quick. You often see me talk about this slide. This is April 28th of 22. Strong bull breakout. And then if you look below, you have this breakout, which is this same one here. You see, obviously, it's a micro channel, but look at a 1-minute chart. All the bars are they're contained really well. And because of that, and there's not a lot of overlap, it increases the chances that the market's going to go higher. But then right here, look what happened. The market broke far above the channel, and because of that, it became climactic. And that's what happened right here. It's a climactic bar, increases the probability we're going to go sideways for a couple of bars. Whenever you're in a trading range, you get a lot of climactic bars, and big bars usually lead to sideways trading. Big bar 14, sideways. Big bar here, sideways. A little bit bigger here, sideways for a couple of bars. Two big bars, and then in this case, reversal. Big bear bar 42, sideways for a bar or two. Big bear bar 47, sideways for a bar or two. 54, weak follow through, but it's not a bull bar, so that's good for the bears. And then 55, a low one short, probably buyers below, and you can see bulls bought it. 56 is a bull bar, and it's a low probability buy, but it's reasonable for always in bears to exit. Aggressive bulls might buy, but in situations like this, with the channel down being as tight as it is, and because it's a micro channel from here to up here, it lowers the probability of bulls buying. So there's probably only a 30% chance that this is actually going to be a low, and more likely any reversal up will be minor and will form a trading range. 57, doji, weak entry bar, and then 58, we tried to rally. We tested near the 52 low right here and the midpoint of the day and sold off. What about selling below 58? I would not. Channel up's pretty tight, lots of bull bars, and we're near the bottom of a trading range. So there might be more buyers below than sellers. 59, bull bar, inside bar. Reasonable to buy the close or buy above, but the only problem with that is the channel down is tight. So some traders buying here, they might buy but exit really quick if we fail to get a strong upside breakout. This is the problem you're facing, that the bulls are facing right here. Tight channel. So here is 1320. This is 1320. Tight bear channel, low one short, probably buyers below, but probably a trading range at best. And you can see there were buyers below here. We went higher, but we still ended up going lower. 60, doji. So probably buyers below 60 and probably going to test closer to the moving average. 61, another doji, and then 62, a big bull bar, a little bit of a surprise, but the market's not clearly always in long. Possible wedge, 54, 58, 62, but 62 is enough of a surprise. Probably buyers below 63, unless it's a really big bear bar. 63, weak bear bar, probably buyers below. 64, outside up, but when you look at that, does 64 look like a strong? Is the market clearly always in long at 64? No. What do you notice about 64 compared to 42? 42 is breaking below the moving average, and then the market started to stabilize below the moving average. So rather than traders aggressively buying the moving average and the market reversing, like right here, the market broke below the moving average and started to stabilize below the moving average. So look right here, the market rallied and stabilized at the moving average underneath it, and the bulls could not break above it. And that led to a downside breakout on 65. Is a little bit of a surprise, but it's probably exhaustion, and it's a test of the midpoint of 9 and the high of bar 8. So there might be more buyers on the close of 65 than sellers. Some traders will wait. Instead of selling 65, they'll wait and see the follow-through. And you can see the follow-through was disappointing on 66. Other traders, they'll sell the close of 65, and then when 66 raced up, they'll scale in. And then when the 66 retests the close, which it did intra-bar, they'll start to buy back shorts. That's why if you go back on something like Market Replay and rewatch this, you'll notice that this bar closed, this bar sold off and rallied, but then it immediately sold back to the close of the bar and started to hesitate. And that's because you had bears and bulls buying near the 65 close. 66, it's a weak buy above the bar, so some traders will sell or sell the high of 66, betting on a second leg down. But then you have 67. 67 is bears not aggressively selling. So the bears are not all that excited to sell. And if you have a bear breakout on 65 and the bears are not eager to get short, that means there's not momentum behind the bar. It's a sell vacuum. And in this case, it's a sell vacuum test of the 11 close and the midpoint of bar 9. 66, enough of a surprise, may get a small second leg, and that's why there were traders buying the retest. And then 67, big bull bar. What about buying the close of 67? Some traders might. It's a retest of the moving average. But 68, some traders might buy the close. It's a retest of the moving average, probably going to go at least a little bit higher. Follow through 69, outside up 70, but this looks like a leg in a trading range, and you're getting near the 64 close and the 64 high. There's probably resistance not far above. 71, bear bar, probably buyers below. 72, a bull bar closing on its high, but we rallied on 69, sold off, rallied on 71, sold off, rallied on 72. We could quickly sell off on 73. It'd be a wedge. So let's look at a 1 minute chart. And it should be right here. That's not right. It's actually going to be here. So 72 is 1430, which is right here. So what do you notice? Breakout, sell off, first leg, pull back, second leg. So the second leg was 1427, which is this bar. First leg was 1420 to 1421 here. So 1, 2, 3, and then we sold off. 72, bear bar, but probably buyers below. Some traders, instead of buying, 73, bear bar, probably buyers below. Some traders, instead of buying below 73, they'll wait and see the bad follow through below 74. So instead of buying below 73, they'll wait and see the doji, and then they'll buy below 74 because it would be a second leg down. 75, second leg down, retest of, it's a failed breakout of 70, and it's a retest of the 66 and 67 highs. And that's why 76 reversed up. 76, bull bar, 2 or 3 pushes down. Probably going to go sideways. We still have the targets, the 4,400 big round number, the 64 high, and the midpoint of the day. And then you can see at the end of the day, we rallied back to 4,400 and closed above 64. We're always in. I think it was reasonable. I think it was more, for always in, I think it was less reasonable to buy the close of 2. In general, because of the gap down, and the odds are the bears will get at least a brief second leg down on the open because of the gap. It's really better to wait for a stronger breakout like 8 or 9. Always in long, you don't have to get out below 15. If you do, you get long again above a bar like 19. And if you bought above 19, maybe you get out below 20, but it never triggered, or you buy 21. And there's really no reason to get out. If you get out below 30, you buy again above bull bar. If you get out below 29, you buy again above 30, but you don't have to. First reversal down probably will fail. And then bears probably sell below 37. Bulls get out. And where do the bears get out? Some traders might get out above 41, but it's the first reversal up. If they did, they probably sell. This part's pretty tough. They probably just sell below any bar, and maybe they put a stop a couple of points above, betting on a tight bear channel. The reality is, if you're selling a bar like 42 and 43, you're betting on a small pullback sell-off. And that's what you pretty much got here. So the bears, if they're short, they might put a stop a couple of points above any bar, and maybe they get out here. Do the bulls buy above 44? Some might, but it's a low probability buy. It's consecutive bear bars below the moving average in a fairly tight channel, and the bulls haven't made money in several bars. And that's a breakout on a higher time frame. So 44 is actually a lower probability buy. Always in bears can exit above 56, betting on a sell climax, bear breakout below the channel, and sideways to the moving average. If they do they sell again below 68? Some traders might, but I think there's probably more buyers below. And you can see here, it never triggered. And then for the bulls, if they bought above 56, maybe they get out below 58. That's pretty common, where you get a buy signal, even though the channel's tight, and then you get a low 2, but the low 2 doesn't trigger and the market rallies. At some point, where do traders get out? I think it's okay for bulls to get out below 63 or get out as this bar starts to go down. and then bears will sell on the way down. But then where do the bears exit? Well, the problem is if you're short on this bar, it's probably exhaustion. So a lot of traders, when the market starts to go sideways and then it starts to reverse up, a lot of those remaining bears will exit wherever the market is. And then here, it never really went always in long. If traders buy the close, 68, 69, they probably get out somewhere in here. Maybe they hold, but it's so late in the day, I don't think it's worth it. For stop entries, I thought it was okay to buy above 13 or 21. You can even buy above 24, but I'd rather wait and see the follow through like 25 or the close of 26. Some traders might buy above 30, or they would wait for 31 or 32. And then I thought it was reasonable as far as stop entries. I thought it was okay to buy above 13, 21. You can sell below 37. This is really, really tough. It's tough to get short and it's tough to buy. So a lot of traders, it's pretty easy to get trapped out in this. I thought it was okay to buy above 56, but that's really a weaker buy. And then there really wasn't a great stop entry anywhere in here. For limit orders, buyers below 3, scaling in lower, probably buyers below 10, and probably sellers above 11, but not really that great. And probably buyers below 29, but selling at yesterday's high in a climactic rally, so you have to be quick to make decisions. And then I thought there were sellers above 40 or 41 for a second leg down. And then probably buyers below 55, buyers below 57, buyers below 60, and buyers below 67, but it never triggered. And then really buyers back at these breakout points, like the 66 high during 75. That made sense. Buy the close, sell the close. Probably buy the close 8, buy the close 9. Buy the close of 21 or 22. I thought that was okay, but 22 is a little bit aggressive. You're really close to this target. Buy the close 25, 26, 27. Probably okay. 28 is less okay because you're right at resistance, yesterday's high. Probably sell the close 39, sell the close 40, sell the close 42 or 43, but really, really tough. As far as selling the closes of 42 and 43, I personally would not. You could easily get a reversal, but if you're selling the close of 42 and you're putting a stop above, you're taking a chance that the channel's tight. I think it's better to wait for follow through. And here, the reason this is happening is traders are selling pullbacks. And then it wasn't clearly buy the close, sell the close, really anywhere in here. So really you could argue that buy the close, sell the close for the rest of the day for the next 40 bars was not all that clear. Let me take a look at a few more questions. Question, what's the difference between the Globex 5-minute chart and the regular hours of the 5-minute chart? In other words, what's the difference between the ES.D, which is the day only, or the RTH, and the Globex chart? There's no difference. The Globex market, I think a lot of traders might have an easier time using the Globex chart. I say that because for one, on the open, and when I say using the Globex chart, it can be helpful when you're trading to at least glance at the Globex market. So here we've been selling off, and then on the open, here's the open. Right here, we gapped down. But we gapped down fairly recently, and this might be some sort of final flag. Tight trading range, bear breakout, probably going to go sideways. But as far as trading it, there's no difference. 3 pushes down, 1, 2, 3. We got a reversal up, follow through, so buy the close, and you can hold. And then obviously, you just trade the chart in front of you. If you're going to trade the day only, which is the ES.D or the RTH, obviously that's how Al and I talked about the day for pretty much the whole day. You buy the close 8 and 9, and it's a spike, pullback channel, and obviously we just went over everything else. But you don't treat it any different. Okay, would it be reasonable to buy the close of bar 36 or buy more above a bar like 41? I've already answered that one. The question was, would it be reasonable to buy here and scale in, and then what do you do here? And my answer was, if you buy here and you start to get 2 or 3 consecutive bear bars, it's better to get out. these bull bars, they look like bull bars, but they're really pullbacks of this type bear channel. Here's a question about when you start to become more profitable or improve in trading, what's it like? Is it gradual, or does everything fall in place relatively quickly? I think it's gradual for most traders. Most traders know what to do. They just can't process enough information fast enough. And that's kind of why I like flowcharts, and I like to think about binary decision trees. And the reason for that is when you think about trading, think about all the things you have to think about in one bar. When Al thinks about trading, it's really easy because he's done it for so long. But for most people, you have a lot of things to think about. Do you buy? Do you sell? Do you enter with a market order? Do you enter with a limit order? Do you, where's your target? Where's your stop? I would challenge you to get a sheet of paper, and for any bar, write down every thought you have to think about. Is the market always in long, always in short? Is this a breakout? Is it a reversal? Do I buy with a stop? Do I sell with a limit order? Do I sell with a stop? Do I buy with a limit order? How big's my position? How much risk do I use on the trade? There's several pieces, and you have to find a way to be able to think about things from a very quick method. It's kind of like driving a car. You don't think about when you're driving, if you're being a defensive driver, so to speak, you don't have the ability to key in on every piece of information. But the longer you drive a car, the more you can react. If a car slams on its brakes, you can just instantaneously, if you're paying attention, slam on your brakes. Or, if there's something in the road, you can quickly get out of the road. But, it becomes more reflexive. But what traders should focus on, I think, is always in. If the market's clearly always in long, only look to buy until there's a strong trendline break. If the market's clearly always in short here, only look to sell, only look to buy after a strong trendline break and a retest. But I'll talk more about that fairly soon. All right, so looks like that's all the time I've got for questions. As far as tomorrow, I think we're going to be sideways for the next several bars. So probably sellers above, probably buyers below, and probably going to form a trading range. We have an outside bar, and yesterday was an inside bar. So I say that. We have an outside bar today. So it's possible tomorrow is an inside bar. Maybe it's a bear bar closing on its low, and the bear is trying to get a sell-off back to 4,300. Or maybe it's a bull bar, and the bulls break to the upside. What do I think is going to happen? I think we're going to pull back and test near 4,350, and then try and get a second leg. But we'll see. All right. Thanks, everyone, for watching, and I will talk to everybody soon.